Esteemed Chief Guest, CA SN Rajeswari, Member, Distribution, IRDAI, the galaxy of resource persons of the day, CA SN Jayasimhan, and is the Joint Director IRDAI, CA PS PRABHAKAR, CA Venkatakrishan, CA Vijay Kumar, the CA Panaraj, Secretary of SIRC, Regional Council Member CA Geeta, the participants of this evening program, a very pleasant good evening to all of you. It is most gratifying for me and for my colleagues in SIRC to have the gracious presence of our Chief Guest, CA SN Rajeswari, Member Distribution IRDAI, and other seasoned and expert speakers of this evening. Their august presence and their sharing valuable thoughts on various aspects that govern the insurance sector would, I am sure, make this evening an enlightening and worthwhile spent time for all of us. I am extremely pleased to express our sincere thanks to each one of them for accepting our request to be in our midst. On behalf of SIRC, I convey our warm and hearty welcome to our Chief Guest, CA SN Rajeswari, Member Distribution IRDAI. I am happy to welcome all the resource persons, CA Jayasimhan Sir, Joint Director IRDAI, the CA PS PRABHAKAR, CA Venkatakrishan, CA Vijay Kumar. I also extend our warm and hearty welcome to all the delegates to this excellent program. Over the years, the level and the area of activities for chartered accountants have become multifold and multifarious beyond the conventional audit and accounting services. One such area of activity where the chartered accountants are playing a pivotal role in the field of insurance. The professional opportunity in the field of insurance are plenty, and therefore it has become imperative for our members to acquire expertise to make a mark in the insurance sector too. SIRC, considering the enormous amount of scope of professional opportunities that chartered accountants do have, we are organizing various programs on insurance, educate, enlighten, and encourage members to take advantage of the prospects in the insurance sector, and thereby prosperity in the professional arena. SIRC on its part coordinates with the ICAI committees to organize continuing education program, and the program today is one such initiative of SIRC. The inaugural address and the presentation by the erudite resource persons at the technical sessions on three key areas in insurance in respect of regulatory, new professional avenues for chartered accountants, and risk management would bound to give the audience an overall perspective and enhance their horizon of knowledge that will stand in good stead while they perform insurance audit. We have great pleasure to record that our profession has a pride of place in the insurance sector as one of our senior members of our profession. CAN Rangachari sir was the first chairman of IRDAI. He was credited with the formulation of regulations for the insurers and made a mark of reforms in the liberalized era. Our professional fraternity, known for setting high standards in rendering professional services and exhibiting their prowess in any field that are assigned to them, has also been contributing enormously in the insurance sector, discharging different functions, be it in finance, audit, underwriting, administration, and other departments. Many of the chartered accountants are employed in various insurance companies in top positions, and our members in large numbers are involved in offering their service in professional capacity in the insurance sector. The resource persons of today all are chartered accountants and have made an indelible mark in the field of activity. CA PS PRABHAKAR, one of the resource persons, has been a source of support to the institute. Whenever we at SIRC plan to organize programs related to insurance, he will be in the forefront to guide us. He had also served as a co-opted member in the insurance committee of ICAI and SIRC as well. There were wide-ranging professional opportunities available for chartered accountants. It is therefore an excellent opportunity to the participants to have an analytical approach and newer exposure from the experts. I am sure this program is an ideal platform for our members to learn more about insurance when learned resource persons provided an overall view of the role of chartered accountants. To say in a nutshell, the chartered accountant known for giving value addition to their clients can enhance their services with a greater experience and exposure in the field of activity by attending this program. My sincere thanks to the Jayasimhan sir, who helped us for arranging this excellent program of today with the support of Dr. D. Paramasan, Joint Director of SIRC. With these few words, I once again extend our warm and hearty welcome to the chief guest and the resource persons and all the delegates of this program. Before into the main agenda, let me introduce the chief guest of this evening to the viewers. She is a qualified chartered accountant. She did her MBA from Bharatiyar University and is a fellow member of the Institute of Chartered Accountants of India. Her career spans over a period of more than 37 years in the general insurance industry, starting in 1984 as a direct recruit officer in United India Insurance, where she had a good experience in various fields like marketing, technical, accounts, and finance. She moved to New India Assurance Company Limited, Mumbai, on her promotion as a Deputy General Manager and the CFO in the year of 2012. She was promoted to the cadre of General Manager in 2015 and has worked in capacity of Financial Advisor, Chief Financial Officer, and has immense experience in technical, reinsurance, marketing, and other related areas. CA S.N. Rajeswari was the Chairman cum Managing Director of the Oriental Insurance Company Limited. Recently, CA S.N. Rajeswari has assumed charge as a member distribution of IRDAI. With these few words, I am very much happy to introduce the chief guest, the pride of our own fraternity, CA S.N. Rajeswari, madam, to the viewers. Now over to the madam.
Thank you. Good evening, all CA fraternity. Belated wishes for the CA day. Just now I was seeing my mobile. I got a message from my statutory auditor of United India head office. He was messaging, I am watching your speech, like that. So I was so happy to be connected with the CAs whom I have been working, who were associated in the companies all. So I cannot forget the days when I was a faculty in the CA chapter at Coimbatore, Salem, and then Chennai also. So I recollect one of the senior CA used to tell me when I'm not going to the chapter, he used to tell me wherever you go at whatever level you go, you have to always remember that your umbilical cord is with CA. That I really agree. So it's because what the CA qualification has given me, I am in this position. I could elevate to this level and chairman or CFO and then chairman of insurance company and now a prestigious member post. It's all what the CA profession has given me, so I cannot forget that. Of course, for those who are in the company in profession and employment, it is very difficult to get connected. Even I try to attend some classes, even that online all, but it was, since it is not focused to our job, our profession, it was even in days when I attended, it wasn't over also. I could not continue, though I want to be connected always. But this is a great opportunity I got, so I thank SIRC for this opportunity. And I thank all CAs. We all are doing a great job. Either we are in profession or in practice or in employment, we are doing a great job, and we are doing a very vital role in insurance, and we can have a still more role to play. And first, before I start, I have to thank all of you, without whom the insurance companies, both at the branch and the statutory level, would have found it difficult to close their accounts. So all the chartered accountants, either it's a branch audit or a central statutory audit, have been great support for completion of the audits of the insurance companies. That too, I have to say specific reference to the pandemic during last year and current year. I recollect one of my divisional manager of New India told me last year, like midnight around 2 o'clock or 3 o'clock, we got the account signed. There was no power, so we have to put the on the bonnet of the car. We have to keep all the papers when it was about to be signed with the mobile touch. There's a final signature. So the auditor was so helpful. He signed us at that time like that. So thanks to all the entire auditors fraternity. And coming to the insurance part, the growth of insurance industry, I will say it is directly proportional to the economic growth of the country. So when there is economic growth, when new projects come up, investment come up, so there is the need for insurance also arises now. So in the last 2 decades, I can say Indian insurance industry has seen superlative growth. So far, motor insurance has been the major component of business for all these years. But after pandemic of last year and second wave, health insurance has overtaken motor insurance, since the awareness and need for health insurance has been realized by the public. Insurance, which has been a push product, which was treated as a luxury, may not be luxury to a certain extent. I can say it is a comfort, but it was never considered as a necessity at all as a part of life. So what the insurance industry could not do for all these years, this one pandemic made the people realize that they should have a life cover and they should have a health cover. So now insurance, I will say, that is going to grow very well exponentially. That is because due to rapid economic growth, and I say it is directly proportional, insurance growth is directly proportional to the economic growth, and there is favorable government support, rapidly growing middle class population, innovative products and distribution channels are coming and they are in the pipeline. The regulator has also introduced sandbox products, given opportunity to the insurance companies to try their products in the sandbox. And now high penetration of the digital platform has started and people have started showing interest. Not only that, the disposable income of the people has increasing, and the need for protection and retirement planning have also increased. So these are the favorable demographic factors for the insurance sector. So when insurance sector has enabled growth, it has enabled across various sectors. Say it is a real estate, some manufacturing, auto sector, health project, everywhere. Without insurance, it will be difficult. No sector can take up any long-term projects or growth confidently if they are not backed by the underlying insurance protection. So insurance plays a very, very major role. Under the regulated environment, as you know, massive funds are being managed by both life and general insurance companies. Of course, Mr. Jayasimhan will be talking on that also. But I can say with pride, the regulator role is very, very crucial in that. The regulator has been very, very supportive and guiding the industry in managing the investment. So we can say insurance sector can say with pride that even when the stock market crash is there, when US faced the music hall, the Indian insurance industry didn't face so much downfall at all. It is because of the regulatory control over the investments. So this has been very successful. So the insurers not only provide financial security and peace of mind to the households and business, they are a vital source for the long-term capital, providing stability to the financial markets, risk mitigators, and the overall economy. I'm very happy to note that one of the topic is risk management, which I consider very, very important factor for any company. This risk management, risk assessment, management, mitigation is very, very important. So I even say the CRO of a company has to play a major role. Even the CRO can monitor the functions of a CEO and CFO, because the CRO role is very, very vital. Going back to the topic again, considering the low penetration and density in insurance in India, which I can say not even half of the world average, leaves tremendous potential for growth. Of course, there was significant growth in the last decade also. One of the major reasons what we saw is a crop insurance, which has witnessed exponential growth post implementation of the PMFBY. So thanks to the government initiative, which has launched multiple flagship life insurance pension scheme to promote social security, financial inclusions and whatnot. Some of the schemes you will know: PMJJBY, APY, PMSBY, and then issuance of DigiLocker for policies. And the latest, I can say, the proposed IPO of LIC in financial year 2022. So these are the new initiatives taken by the government. Last year, IRDAI increasingly focused on standardization of insurance products and launched numerous products fall in line with the corona also, like Arogya Sanjeevani. We introduced Corona Kavach, Corona Rakshak, Saral Jeevan Bima in life side, and Saral Suraksha Bima for the personal accident side. So, and coming back to the government, current year, to attract more overall capital infusion, government has increased FDI in insurance sector to 74% from 49%. You know, insurance business is very much capital intensive, and this 74% will help for more penetration, innovative products, and bring in more technology and expertise from across the globe. So insurance industry saw a growth of around 5+ only in March 20 because of the pandemic at the last foot of the financial year closing. And March 21, it grew at 9%. Happy to note that up to May, it has grown in a double digit at 17%. And we are very confident the double digit will be maintained and it has to grow exponentially in the coming year. Current year, the government focus, also the regulator has focused on the MSME, and standard products for them have been created because they have been the neglected sector, and also due to pandemic, they have been suffering a lot. So, and also more focus is on digital, which is gaining importance. Insurance industry has been in the midst of digital transformation. This technological shift has been accelerated by the need to address the challenges brought by the pandemic. During the second wave, the regulator and the industry stood together in settling the claims without any delay, whether it is death claim or health claims, very, very fast. I can say 86% of the health claims were settled with cashless was given within 60 minutes. And the repudiation level of the claims is also very, very low. So coming to what CA can do with the insurance industry, how the wedding between the insurance industry and the CA fraternity can happen. So the dynamic economic environment, first thing I have to say, requires the CA to think and shift their role from being an accountant, auditor, or only financial analyst to business advisors and strategists. We have to change. So besides the traditional field of statutory audit, internal audit, tax audit, GST compliance and GST audit and training, international taxation, there is now vast scope when you come to the claims part. So like CAs can function as a surveyors, loss assessors, and claim negotiators. As arbitrator, there is a major role CAs can play in the resolving the insurance claim disputes. Already you will be doing many companies, at least I can see the private companies have concurrent audit which will be done by the CAs, and a mandatory requirement is the investment concurrent audit as per the regulator. So you will be part of that also. And now what is picking up is the forensic accounting and audit is gaining importance, and CAs are playing a major role and they have major role to play. And one more thing is many companies you can see these mergers and acquisitions is taking place. So there of insurance companies there is a major role. And important is the IPO and FPO of the companies. So there with my experience in New India, how we coordinated with the CA firms, it was a learning. Even for the CAs who have not done as a central statutory auditors, who have not done IPO, of course, bank IPO, you would have been exposed. A little different will be insurance IPO, getting into what are the regulatory requirements and other things, right from assisting in the drafting the DRHP. I can remember midnight we used to sit and circle the and rounding up and then verification, first round, second round, third round, like that. So there is a major role in IPO and FPO. And when Ind AS comes, though not immediately, say after 2 years or 3 years, so the role of chartered accountants will be very, very high. Of course, there will be role of the actuary also on Ind AS 117, but I feel your role also will be, though not that much in 117, but in others like 109, you will be playing a major role. And as you know, the investment risk management audit is mandatory by the regulator. Once in 2 years, every company has to undertake this audit also. And CAs are in the board of the companies as independent director, and they play a major role in the audit committee, either as an auditor or as an independent director. CA play a major role, and as per the corporate governance of the Companies Act also and the listing requirement, so the independent director, the chairman of the audit committee, should have experience, the financial experience. So preferably a chartered accountant. Also, even we had the government companies, public sector companies had independent director. One CA will be in our board. So it is always there. And as discussed, you play a very, very major role in the risk management and assessment and financial modeling. Now the new one upcoming is the intellectual property valuation. So there also your role will be very high. So along with your forensic accounting and audit for fraud and insolvency analysis, you will play a major role. And since insurance has huge data, so you can also come out with ideas for data management, and you will be playing role in cyber security. And you can also, along with the companies, come out, help in the companies in designing or devising a product and the features of the insurance product. New innovative products can be done. Now it is not the standard product of 1 year in the sandbox or like pay as you drive. It's there. Telematics is able to help how an insurance product can be managed. So how a driver's driving experience will qualify for the premium, rating, everything. So CAs can play a major role. And then, as you know, you are already focusing on the internal financial control. But according to me, there more focus when you review the company, whether because this internal financial control and the risk management have to be matched and tied together, whether they are having its manual records, yes, risk register, everybody has, but whether they have a system based triggers are there when something goes wrong, whether their system can trigger up and say that an alert message can come. That is all. It's not only the physical files you have to answer, you have to audit how is their system, how is their IT system, core software, how is their risk management or risk assessing mitigation software. So that is very much required, which you have to see. This is what I want to say. I want to start with saying that C.H. Sri Rangachari was the first chairman of IRDAI, But since Mr. Jalapati started with that, I didn't want to say. We have a pride that already the first chairman was a CA. And as you know, there are many chartered accountants as a profession. Also, like employment, we all are there. Like who create, I can remember Mr. Chakravarti was there, Mr. Garg was there. So I was there as a chairman. And also they are in the board and top level as a GM level. Many people are there in the senior executives and also many in the middle and lower management. There is a special recruitment also going on for account specialists. So this is how you have so many opportunities in CA. So with this, I thought I will conclude. So I look forward for your excellent association with the insurance industry. All the best to all of you. Stay safe. Thank you so much for the opportunity to SIRC. Thank you, sir.
Yes, thank you very much, Madam, as Secretary of SIRC. I wish to place on record the sincere sense of gratitude for your time and your sharing your knowledge of wisdom, because having put up 37 years of service in the insurance sector, you have
When I think that it seems to be too long, sir. Don't say. Of course, and one more thing I want to say, sir, the CA also, when they enter into the insurance industry, they should try to understand the subject, which is very important. The technical subject also they should.
Exactly. Whatever we study in the academics is very thin and very small amount of knowledge, but you have grown like a ocean there. The very presentation of yours and explaining the number of arms in which the CAs can contribute in the insurance sector, that's very amazing. And we at SIRC under the leadership of our chairman have been stressing upon entering into the non-traditional areas, as you rightly pointed out. And within insurance sectors, you highlighted so many areas where there is a very great opportunity. So we are definitely indebted to you for being here and very proud to have a chartered accountant like you at the helm of the affairs in IRDAI. And definitely you have made our day today by giving your opening remarks in a very befitting manner. So definitely our program, you have set a very good tone for the program for the day, and we thank you very much on behalf of SIRC for being here.
Thank you, sir. With your permission, I will just log off when meeting is started. So I will. Thank you, sir. All the best to all CAs. Stay safe. Thank you so much.
Thank you so much.
Thank you very much.
Thank you.
I now request Madam Geeta to move on to the technical sessions with the permission of chairman.
Yes, sir. Please proceed, sir.
Yes, Madam, please introduce the speakers of the first session. Madam Geeta, the regional council member of the SIRC.
Yeah, distinguished chief guest, CA S. Rajeswari, and first person of the region, CA Jalapati, and our speakers of the day, CA Jayasimhan sir, and CA PRABHAKAR, CA Venkatakrishan, and CA Vijay Kumar, and my dear viewers. Happy evening to all of you. It's my privilege to introduce a person who has backed the CA Professional Achiever Award for public sector category and regulators category in the year 2010 and 2016 respectively. So it's none other than CA S.M. Jayasimhan. And a chartered accountant and has more than 25 years of experience both in private sector and is a regulator regulating insurance investments at Insurance Regulatory and Development Authority of India. He joined IRDAI as a first direct recruit and has specialized in policy making, supervision, inspections, planning and analysis, systems and designing, and IT systems implementation. So his specialty has been to handle regulatory changes with minimal operational disruption with accessibility across the industry. They have been regulating insurance investments for the last 2 decades and have been instrumental in implementing all the 6 regulatory amendments over a period of 15 years. CFL Jayasimhan has been associated with ICAI in various countries and through IRDAI with International Association of Insurance Health Supervisors to build industry best practices in the area of insurance investments. So with this brief introduction, on behalf of SIRC and ICAI, we once again welcome you to this virtual session, sir. We have yet another speaker, eminent personality, Sri PRABHAKAR, to share his knowledge with our members. There are 4 decades of post-qualification experience, out of which 11 years in the Indian public sector insurance industry, 7 years in a Gulf insurance and investment company, and presently in 23rd year in active professional practice. Currently, the president of the prestigious Auditors Society of Auditors, Chennai, an organization of nearly 90 years of standing. He was a member in the non-standing committee of banking, insurance, and pension of Institute of Chartered Accountants of India, New Delhi, for 7 annual terms. And he has been a member in the IRDAI Standing Committee on Accounting Issues. In a group in bringing out the technical guide on internal concurrent audit of investment function of insurance companies, a joint initiative of IRDAI and ICAI. Presently, the deputy convener of the subcommittee of AASB of ICAI formed to bring out an updated guidance note on the audit of general insurance companies. We engage regular panelists in the discussion forums in AIR and Doordarshan, and several private channels on matters pertaining to economics, finance, governance, and politics. He has been a prolific writer on various issues concerning profession, on topics such as insurance, IFRS, taxation, and multinational accounting firms, and on non-professional matters as well. So with this brief introduction, I once again wholeheartedly, on behalf of SIRC, we welcome you to this session, sir. Thank you. Go to Secretary. Whenever, sir.
Sir, Jayasimhan, sir, you can proceed, sir. You can start your presentation, sir.
Sir, you're muted, sir. Unmute yourself. Yes, presentation visible.
Good evening. Good evening, sir. I would like to thank all the panelists, and I need to acknowledge their contribution to the insurance sector as a whole, and particularly in the investment management. I need to certainly tell that my formative have almost completed around 20 full years of my service in IRDAI. If we people have gone through all these 20 years, I need to definitely acknowledge the contributions of from among the panelists, the contribution made by Mr. P S Prabhakar, Mr. Venkatakrishan, Vijay, from both on the operational side and the system side. And inside IRDAI, have been running it through for the last 20 years. And certainly I need to acknowledge one more person from the CA Institute, Mr. Dr. Paramasivan. So has helped us to bring out whatever we people require to get it done through the CA Institute. So with this, I would like to just go through like how we people have gone through for all these many years. Much before I could land onto the investment side, I would like to tell you like the evolution of insurance as to how it started and what is the role of an accountant and where are we now. Much before we people could see how it is being handled and how we people take care of the public funds. Okay, I'll proceed like this. What brought insurance? This is the first thing that I would like to tell. And in that one, we would like to know the evolution of a modern man as to how we people as modern men, how it started. The Stone Age man was a carnivorous fellow. He faced intense competition for food from other animals. He lived in caves, but in groups. The groups required food in large volumes. This required him to run and hunt for food, which was an ongoing taxing issue. His physique was not built for this activity, but bigger animals, which ran less than him, had no problems with his food. They did not run and hunt for food, but food was available in tons. Also, the food did not run because such big animals were herbivorous. So this is the difference between the way the carnivorous and the herbivorous made a big difference. He chose to be herbivorous to stop running. Thus, he had enough time to think. The thinking faculty brought the modern man to this planet. This is how we people evolved as a modern man from a Stone Age side. Okay. Next step. Modern man to an accountant. Thinking increased the group size, which is the collective strength. A defense mechanism thus involved the joint family system, which was the first insurance to live safely. This is how it evolved. Bigger groups demanded more food, which required a systematic approach to produce that food. The systematic approach was none other than the agriculture. The demand then slowly outpaced the production, and first demand and supply imbalance started. This brought the producer, the consumer, and thus the barter system to share the foods started. Demand and supply required thinking of when, what, and how much was shared. So this required accounting, accountant, and thus the financial system. This is how we people moved over there. An accountant in the financial world. Financial system replaced the food with the non-food items and thus pushed the barter system slowly outside the world. Financial system was very fast, keeping track of the demand and supply better than the barter system. Scientific inventions got the gadgets to speed up the already fast financial system, so accounting became ultra fast. In the last 5 generations, at ultra fast speed in accounting, demand and supply moved the basic food underlying to support the financial system. Today, we are stuck with a paper money which has no food underlying and have gone with derivatives where you need to assume everything as facts. Lifeless paper without any food underlying is imagined for consumption. So where is life and what is this insurance? Life and insurance. Life on this blue planet started in the Great Rift Valley, the eastern corridor of this African continent. The original human race was the great black race, from which emerged all the other hybrid races. Please understand, from the black race, we are all hybrids. The original black race is the one with which we started. Hybrids cannot produce and are prone for all different types of diseases. Today, the original black race has got wiped out of this world. So all of us, the hybrids, are prone for various diseases. Thus, we live a substantial life. But our medical advancement had increased our length of life. So the society also moved towards protection of assets and property to handle the contingency towards losses and value erosions. In effect, we live a substandard and an elongated, hard life. Thus today, insurance companies are expected to provide cover for this substandard and elongated life. The current situation, demand and supply imbalance of food are at alarming proportions. Science has increased the longevity of already aged population, tilting the nature's balance almost in all species, including human beings. Human population explosion has resulted in regional imbalance in the food production and consumption. US is planning to build a wall to stop people crossing from Mexico. This is how things have progressed today. Our living methods had pushed other species to the edge of this world. So food for a natural and healthy living has disappeared. Joint family system, the first natural defense that we people had, which is known the true life insurance, is not available. States are now compelled to provide cover for life, health and assets held for living. Thus, we need a hard or at least a dependable system to retain the leftover organic assets. This is where we are now. What have we done for ourselves today? Economic pressure, general economic depression, sluggish growth, high inflation, Eurozone crisis, COVID. These are all we people have started calling it as challenges. Political and systemic risks which have hit the banks are slowly creeping into the insurance sector as well. Now, political and supervisory bodies driving financial reforms both at global and local levels. Local regulators will be compelled to reframe regulatory requirements. It's a mere firefighting exercise. IFRS. This is a self-inflicted challenge. In Europe, the Solvency II demands infrastructure and systems to be in place. Now they are planning to issue COVID bonds as well. Now, operational pressure and dressing of our balance sheet, it's a mere stunt work. A tough 2019 to 21 requires insurers to realign their products and capital structure. Regulators will definitely push the transparency demands. Skill sets to manage these pressures are not available as it is an abnormal situation. Thus, remaining in the business itself is a major challenge. Now, consumer pressure. Consumer sentiments are awfully low and time for mis-selling. Regulators' intervention to guard consumer, if at all, will be felt as disturbing the level playing field. So to move forward, we need to demonstrate transparency both at consumer and at the regulator as well. Improve the operation efficiency to handle the current, particularly the COVID crisis. Have a hold on your operating cost. You need to retain your consumer base. We need genuine products to see through the COVID crisis, at least for the next 5 years. Have a hold on your sales, particularly mis-selling will be on a rapid pace. Protect the investments made out of these risks and ensure adequate resource to handle the customer commitments. So if we need to sum up, it's like this. Accountant moved the world from barter to a financial system. Accountant permitted non-food items to substitute food in money. Accountant to establish supremacy and control over others failed to ensure food within the money. Today, for a substandard and protracted life, we need risk cover for life, the property, and the health. So, what are these insurance investments? What is expected out of accountants? Where are our accountants towards this need? What systems do we have to guard these investments? And so, in effect, we need a transparent institutional framework that can be believed to retain an organic insurance asset for a possible safe future. This is what we need to demonstrate. I'm just continuing. Capital market entities, how different are they? Much before going into it, I would like to tell you, this is how I was inducted into IRDAI by Mr. This is something what I wrote to Mr. Nandachari. This is how he told me as to how, when I asked him what sort of a design that I need to plan it for this investment, he said like, this is what he said. I would like to go into that one. If you look into banking regulator, we people have RBI. Market regulator, we people have SIRC. For an insurance, we people have IRDAI. These are all the capital market regulators. When banks, AMCs, and insurance companies operate in the same capital market, how are these entities different in their activities? Can systems and process for banks, AMCs, and insurance be the same? Can a single regulator regulate all these entities? In fact, there's a growing need. Why should it not be done by the same regulator? But there are other issues. If they understand the issues, yes, it can be. Otherwise, it's too difficult. Okay. How insurance assets have grown from the year 2000, because in the year 2000 only, IRDAI came. So from that stage, you can understand how we people have grown. What's the design of insurance investment systems and process in place? How IRDAI can confirm such systems and process take care of the transactions. These are all the things what we need to know now. Okay. Capital market funds, something different. We people have so many sectors, FMCG, mining, banking, insurance, AMC, pharma, manufacturing, trading. There are so many other sectors also. These are all the major ones, which all contribute to the capital markets, the funds they come. Finally, if you look into the capital market as the capital market big entities from the investment side, we people have insurance, where the money we people call it as whatever you pay as premium. Banks, we call it as deposits. AMCs, we call it as investments. When money is always money, why should we people call insurance as premium, deposit for banks, and investment in the case of AMCs? So this is the problem. This is where you need to know how to distinguish between savings and surplus. For example, if you have some 1,000 rupees if you need for a normal living, and if a person is in a position to earn just around 700 rupees, he will be battling only to ensure that the next day he doesn't go below the 700. So what he will be trying to do is that he needs to take a portion of that one, a small portion from that. He should save that one and purchase a insurance cover. This cover is not for getting the 300 rupees of whatever be the shortfall. It is only to take care of the shortfall. Sorry, not the shortfall, not to fall below the 700 whatever he is making. So that's the reason we people call it as a premium. On the other hand, instead of 1,000 rupees, if you are making 1,500 rupees, the 500 rupees happens to be the surplus. If you want to keep it properly deposited, you find a bank. If you don't mind investing it, you find an AMC. This is how the savings and surplus have made the things different from premium deposits and investments. So if you stand to lose the surplus, you are not on the road. So the systems around the banks and investments, they are not different. But in the case of insurance premium, somewhat, if the systems are not tight, definitely. So that's the reason the insurance investment system will be more tighter than that of banks and AMC. This is the criteria with which we people have gone about designing the entire system here. So let me just go to the next slide. Just have a look at the investments from 2000 as to how it has grown up to this year, last year. We started off it in 1999-2000. It was around 2,10,000 crores. That was the time that I entered into IRDAI. Just look at the way, 3-4 doubled. 2007-8, 8,22,000. 11-12, 16,80,000 crores. 15-16, 26,90,000 crores. 17-18, 34 lakh crores. 19-20, it is 42,53,000 crores. Now, if you take it as of 31st March, we have already reached around 48.5 lakh crores. Close to 50 lakh crores we people are looking at. If you take this as the base year, see the jump. It is owing to this one. The above jump in asset growth requires the systems to address the scalability factor, which we people do it once in 2 years. The systems in place need to be checked for all investment transactions. This is done on a daily basis. This is the way we people handle it as of now. Now, towards this requirement, we introduced audits. And towards that one, IRDAI for systems control issued the guidelines on investment risk management systems and process, and towards that mandated systems and process certification by chartered accountants. I'll come to you as to why we people have introduced the word of certification model. For transaction control, we people mandated the minimum audit scope and mandated internal concurrent audit done by chartered accountants. Both the systems audit are also done by chartered accountants. The transaction controls are also checked by CAs. But this chartered accountant cannot enter into this CA for the same company. So that's the basic internal control. The reason as to why we people went on to the certification model, both your transaction controls are also certification model as well as the system controls. Because the liability side of the balance sheet of an insurance company is the place where we people underwrite the risk. So it's all assumptions. So there are various calculations which go into the risk calculations. If on the asset side also we people have a true and fair audit, which is not a certification one, both the sides will start oscillating. So that the entire balance sheet will go for a toss. That's the reason we said the asset side, which are facts, needs to be certified by chartered accountant. It's a massive certification work. If people have around 48-50 lakh crores in the investment side, it's a huge certification which is happening, which we people have not even imagined as to how it is going on. But it has been going on for the last maybe around 15-16 years. But we have not had any major impact in the capital market, even though there have been so many setbacks in the capital market. I'll just go how we people have gone about managing investments up to reporting to IRDAI. What we did was that initially the investment regulations at IRDAI, we cut it between systems and transactions. And towards that one, we issued an investment risk management systems guidelines. And this covers both systems and through standard operating procedure for all the transactions to cover. For the hardware, software, and various interfaces, we people issued a technical guide for certification, and this is the one which is there, which is a part of our certification work, which we people have been doing it. This is issued through the CA Institute. And from that one, we get a CA certificate and a detailed audit report. It's a checklist which we people have issued. That goes to the insurance company's audit committee and then to the insurance company's board. And finally, that report gets filed with IRDAI. And on the second side, stage 2, there's another technical guide that we people have issued for the transaction audit. This is the one that has also been issued by the CA Institute towards the internal concurrent audit of investment functions. And the internal concurrent audit is also a certification model. It comes with a CA certificate, but it's an exception report. Not all the transaction which just passes through the system are getting reported. Only those transactions which get which do not get properly addressed by the systems and process, they are the only things which will get reported here. Apart from that, from this one, the exception report which comes over here on the non-compliance will also get mixed with this one, and that goes in the name of a Form 4. There's a reporting format in the name of Form 4, which is certified by the CEO, CIO, CFO, CRO, and then it goes to the audit committee, and then to the board of the insurer, and then finally it gets filed with IRDAI. So at IRDAI, we get only the negative feedbacks on policy and regulatory issues emanating out of this one. So once if it comes out, we people immediately take care of whatever be the negative feedback. Once if we people get that one, we amend whatever is required in this technical guide and in this technical guide. And with that one, inside IRDAI, we people amend the regulations as well. So these are all done through a standing committee on accounting issues, which in fact takes the feedback from this side as well as from this side. That's how we people have gone about. If you look into the stakeholders in servicing the policyholders, we have the insurer, we have IRDAI, and we have the CA Institute as well. So inside the insurer, we have this many layers. These are all the various controls that we people have kept. Inside IRDAI, we have the board, advisory committee, regulations, circulars and guidelines, working groups, and through the CA Institute, we people have a reciprocal arrangement with the CA Institute for COBIP. Now IT committee happens to be renamed as a different committee, ASB, WASB, FRRB. And through this one only, we people have issued the risk management systems and technical guides. These two technical guides have been issued. These are all the support structure which are there for the standing committee inside IRDAI to pass any recommendations to the IRDAI. So Terms of reference of the standing committee, this is are all the things. Advice on specific need on accounting, audit, and investment of insurance industry. IFRS suggests the roadmap for its implementation, adoption of Ind AS to the insurance industry, insurance specific standards, valuation procedures, disclosure, revenue recognition, provisioning and asset classification, regulation on insurance investments, best practices of risk management systems and process, such as reporting formats and accounting and investment regulations, other policy issues relating to accounting, investment and audits. The standing committee will make the recommendations and IRDAI will decide how to accept it or how to go about with it in its implementation. This is how it works. Now, the third thing, at a transaction level, how do we people take care of the controls? IRDAI strength or any regulatory body today may not have that much of strength to go into a transaction level controls. But we people have adopted a different methodology for the investment. I'll just narrate this one to you. Within the insurance company, when the premium emanates, rather, exposure check, a feedback will be taken from the mid office. The exposure check in the front office, they will invest. And it will be invested as per the fund mandate. And then investment accounting will start from the back office, whereas the regulatory and its internal reporting will start from the mid office. But there was only one thing which was missing over here, which was the link between the back office to the mid office. So what we did was that we asked them to automate this particular place. So after that one, we took the things inside IRDAI. So the compliance requirement for various fund mandates were taken. The unresolved exception, that Form 4, will be coming over here, exceptions. And once in a year, we people were doing an inspection on the compliance aspect as to how these people have gone about. But the problem that we people had was once in a year was too longer time, whereby we had found that there were so many investments which went outside our controls. So in that regard, we people short-circuited the whole thing, and we people took a certification by the CEO, CIO, CFO, and the board of the insurance company, and it was concurrently audited by the chartered accountants, and it was filed with IRDAI in the name of Form 4 to take care of the lapse in this particular case. And that's how we went over there. Now, towards this one, we segregated the front, mid, and back office functions and its reporting so that the internal control took care of the effective reporting inside IRDAI. Okay. So this is how we people have gone about. If you have any questions, now you can just come back. Thank you.
Thank you, sir. So there are two questions. Can we take it up now, or else we'll take it up at the end? One. Sir, is Ms. being listened? So can we take these questions now, or else can we take it up at the end?
Insurance company should
days when it will be applicable. Please share images.
Can I take it, please?
Yes, sir, please.
Yeah. Say the India's implementation already it has been decided for 22-23, but even there is a long way to go about, because it's not a straight thing, because on the liability side we people have India 17, and on the asset side we people have 109. So between these two sides, it's not that one can go forward and one can remain. So both the things are required to go. That has been going on for quite some time. We have decided 22-23 as the date by which we people will sync all those things and move forward. I think that should be the way in which we will be moving forward. Insurance and investment should not go in hand. There will not be optimization either. So as being the case in IRA, entering insurance as an investment rather than purpose of insurance. No. Insurance and investment should not. See, yes, partially it is correct. I'll agree. See, insurance and investment, it is not that the investment needs to see the amount of investments, whatever we people have seen today, is something what we people have it as surplus that we people have taken care of after meeting the death claims and maturity claims and all the other claims, whatever we people have on the non-life side as well. So it is only the surplus that we people have. This investment is something what we people invest, and that is what is going on right now. I do not know. ULIP investment, in fact, is something where the risk is there with the person who has taken the policy. That doesn't come into this at all. Is there any other doubt that we people have? Let them ask me.
No, sir. We'll move on to next session, sir. Rest will share it over mails.
Okay.
So, move on to next session, sir. Prabhakar, sir, can we?
Thank you, sir. Now over to Prabhakar, sir.
Yeah.
Please take us.
So shall I start sharing the screen?
Yes, please. Sisters,
Yes, sir. You can continue, sir, please.
can I start?
Yes, sir. Please.
Good evening to all of you, my professional brothers and sisters and ladies and gentlemen. Thank the SIRC at the outset for having given me this opportunity to speak on a seminar in which we've had IRDAI member as a chief guest, Mrs. Rajeswari, and of course the Joint Director, Sri Jayasimhan, also as a panelist. And I'm also happy to note that my good friends Sri Venkatakrishan and Sri Vijay Kumar are also there in the panel. Insurance is a subject that is not enthusiastically read about or learned, especially by chartered accountants. If you look at the seminars that are conducted in insurance, I would say that people were not that kind of interested in attending those seminars also for the simple reason they think that there are not many opportunities in insurance. And I am sure once they come to know that there are in fact enough number of opportunities and avenues, I'm sure they would be more interested in this subject, because after all, chartered accountants, we have seen several vistas. For example, when the valuation course started, several chartered accountants became valuers. And when this insolvency professional course started, several chartered accountants became insolvency professionals also, and they are doing an extremely good job. So I'm sure it is the insurance is not something that is not possible to be done by the chartered accountants. That said, I have chosen the topic new professional avenues for CAs in insurance sectors. The term avenues is different from the term opportunities, because opportunities are those that are already available for chartered accountants, but avenues are those that need to be explored. So I'm going to be talking both about opportunities and chartered accountants, but less of the former and more of the latter. Next slide, please. Of course, you have had enough of statistics from Srimati Rajeswari and as well as Sri Jayasimhan on the insurance industry's growth. But what we need to know is insurance industry is important Next, the importance is next only to the banking industry in the financial sector. Because the banking industry, in my opinion, creates wealth. It is the insurance industry that protects the wealth. The insurance industry is actually the protector of the balance sheets of the country and of the corporates. So because of this, it is a very important barometer of economy. And because of insurance, the risks are shared, the risks are controlled, the risks are managed, the risks are mitigated. The country is towards on a safer domain. Next, please. Of course, Jayasimhan mentioned about the growth of the what is called investment arena. How the investment came only because of the premium. From a very small premium base of a few hundred crores, the insurance industry's gross premium has reached something close to 7.6 lakh crores as at the end of March 2020, out of which 5.7 lakh crores was from life side and almost 2 crores from the non-life side. The total investments in the insurance industry is nearing 50 lakh crores, which is much larger, even twice, almost twice than the size of the Indian budget. Today, we have about 60 insurance companies, out of which 24 are in life, including the giant LIC, and 34 in non-life, out of which there are 4 public sector insurance companies and 7 standalone health insurance companies, 2 specialized insurers, namely agricultural insurance company and export credit and guarantee. We have also 2 reinsurance companies, out of which one is the PSU called General Insurance Corporation of India, which is the apex reinsurer for the country. Next, please. The industry, the industry's growth numbers are very impressive, as I was mentioning, but you will have to see the penetration ratio. The penetration ratio is still very low in India. As of 2017, it was less than 3%, and it has not greatly increased in the year 2020 also. But the low penetration means there is a huge headroom for growth. Especially if you look at, if people have mentioned, and we have also seen some statistics, even after the especially after the pandemic has started, we have got enormous amount of growth in both life sector and in health sector for insurance companies. A lot of people who have been probably were under the impression that they did not need insurance. They thought that insurance was a very great necessity in life. So in fact, the life insurance has grown substantially, and also the health insurance also has grown substantially in the past 2 years. So look at the industry, which has been going digital on many fronts. As Rajeswari was mentioning, it is still in the push category because it is still had to be sold, and it is not very eagerly bought, especially on other insurance. Which kind of insurances are eagerly bought? Only because funder-driven insurances are even bought. But you have to look at the issue that the new generation, the next generation, they want to consume content online. So the insurance industry also has adapted to that, and most of the companies are looking at new ways to engage with customers beyond just a static website. Now you can always do a chat, and you can always have doubts clarified. You can have, you can buy policies, pay premium, everything you can do online. Customer education on the online or the order of the day. Next, please. We are not going to be talking too much on these areas of opportunities which are already available. In fact, Madam also was mentioning about the statutory audit, tax loss complaints, tax representations, GST complaints, and consultancy. Except perhaps I would, mention a few things about the statutory audit and what is that in the statutory audit. You can look for more opportunities or more avenues, because the statutory audit itself is an opportunity that is probably available only for a few chartered accountants, because we are talking about some 60 insurance companies, and the best 120 firms of chartered accountants in India only can probably keep doing these audits. And normally the domain is so intensive, knowledge intensive. There are only few few chartered accountants are adept in doing insurance audit. But what happens is, if you look at within the realm of statutory audit, there are newer areas that need to be explored, which I will probably be explaining a little more in the times to come. Please, next slide, please. So the statutory audit is just not a statutory audit. It is actually more than that, because statutory audit of insurance companies are within the statutory realm of Companies Act, because every insurance company has been formed only as a limited company, and section you have this section of 139 controlling the audit objective of the insurance companies. The reporting requirements are all mentioned in the Companies Act itself. But if you look at insurance companies, the insurance companies audit are also mandated by the regulator himself. Not only that, the insurance audit report itself is as per the mandate of the insurance regulator only. So we are not just going by the insurance audit report, the contents of the audit report as mandated by the Companies Act. It goes further, and it has to go according to the insurance regulator. Because if you look at schedule, the regulation itself talks about financial reporting and auditor's report. So auditor's report is one integral and important part of the regulations. If you look at the Schedule C of the IRDAI's financial statements and audit regulations, it says that the auditors have to comment on the assumptions made by the actuarial valuers, as well as the valuation of investments. In fact, I do not know whether any other industry, this kind of things are mandated. How can you comment on the valuation of investment? But then the auditors have been doing it. They also have to certify that they have reviewed the management report and there is no apparent mistakes or material inconsistencies with the financial statements. I will have to talk to you about this management report a little more, because this management report, the reviewing of a management report is a very huge responsibility, and the mandating of a management report itself is something very, very unique to the insurance industry itself. Next slide, please. But before that, I will talk to you about the balance sheet of an insurance company. A balance sheet of an insurance company, even Jayasimhan was mentioning about the liability side and asset side, how they are governed by two different indices. If you look at asset side, most of the figures are factual figures. Accountants control the asset side. Whether it is fixed assets or current assets or investments, the whole asset side of the balance sheet are physically verifiable. Whereas if you look at the liability side, it's all in estimates. You have unexpired risk premium, you have outstanding claims, they're all estimates. And everything comes under the control or of the actuarialist. Actuaries actually mandate the estimates of the liability side, which means you're talking about on the one side, you have estimates. On the other side, you have facts. There is an inherent mismatch in an insurance company's balance sheet. But even though the asset side of the balance sheet are only under the control of chartered accountants and the accountants, even though the liability side of the balance sheet are almost at the control of the actuarial professionals, it is the accountants who have to certify the whole balance sheet, and they are the people who are subject to the rigorous disciplinary mechanism of the ICAI. People say that actuarial course is a very difficult course. It is indeed a difficult course, but to comment on the actuarial valuation is even more difficult, and it is only at the cost and the risk of the huge magnitude. The statutory auditors will have to even sign the balance sheet. I will now go to the management report. Next slide, please. As I had mentioned, there is some management report that is mandated by the IRDAI's financial regulations itself. Look at the management report. All the insurance companies are supposed to submit a management report signed by the CEO of the insurance company. The management report, in fact, the part 4 of the financial regulations, has given a list of about 14 for life insurance company and 13 for general insurance company points, which are called contents of management report. The contents of the management report start from the fact that confirmation regarding the continued validity of the registration granted by the authority, certification that all the dues payable to the statutory authorities have been duly paid, confirmation to the effect that the shareholding pattern and transfer of shares during the year are in accordance with the statutory or regulatory requirements, declaration that the management has not directly or indirectly invested outside India the funds of the holders of policies issued in India, confirmation that the required solvency margins have been maintained, certification to the effect that all the assets have been reviewed on the date of the balance sheet and that in the insurer's belief, the assets set forth in the balance sheets are shown in the aggregate amounts not exceeding their reasonable or market value under the various heads. Certification to the effect that no part of life insurance fund, this is exclusively for life insurance companies, has been directly or indirectly applied in contravention of the provisions of the Insurance Act. Disclosure with regard to the overall risk exposure and strategy adopted to mitigate the same. Now, I want you to listen to the wordings of the content report. See here, disclosure with regard to the overall risk exposure and strategy adopted to mitigate the same. It is okay as long as you ask the insurance company's management to give this report, they will give you kind of declaration. They can give you all kinds of confirmation. Go further. Aging of claims, including indicating the trends in average claim settlement time. Certification to the effect that how the value is shown in the balance sheet of the investment stocks have been arrived at, and how the market value have been ascertained for the purpose of comparison with values as shown. Review of asset quality and performance of investments in terms of portfolios. And finally, there has to be a responsibility statement indicating that in the preparation of financial statements, applicable accounting standards have been carried out. The management has adopted accounting policy and updated them consistently. The management has taken proper and sufficient care of maintenance of accounting, maintenance of adequate accounting records, and the management has prepared the financial statements in a going concern basis. The management has ensured that an internal audit commensurate with the size and nature of the business exists. All this is okay as long as this management report will have to be signed by the management only. But the problem is, go to the next slide, please. The management report, which looks like an audit program by itself, like for example, I have mentioned shareholding pattern and all that, the statutory auditors are expected to certify that they have reviewed the contents of the management report and that there are no material inconsistencies, as I had mentioned earlier, which means this places the auditors in a much larger responsibility than the management itself. Because all these issues, they are not connected to financial issues at all directly. Many of the issues. How do you talk about asset quality, review of asset quality, and how do you talk about the valuation of the market valuation and all that? You are not talking about. India has not yet come. Even before India has come, if this is actually the management report has been designed in the year 2000 itself. We are talking about some 20 years back. This was designed much before even India was ever thought of. So what I'm saying is they have talked about market values and all other kinds of things in the management report, and the management report has to be certified by the auditors themselves as it is correct, which means the auditor's responsibility, even in terms of the statutory audit itself, is voluminous and huge. That what we have to do is we will probably have to impress upon those people who are appointed as statutory auditors will have to impress upon the management that for all these things you need to appoint a different set of auditors from whom we will take the certification, and we will rely on the expert evidence, and of course subject to carrying out all the other statutory requirements in respect of accepting the statutory report and all them. These things will have to be outsourced to several other auditors, and this will probably happen, if not now, very soon. So we are talking about the offshoots or rather offsprings of the statutory audit as huge kind of opportunities that are going to be coming in the chartered accountancy. Next slide. The next slide, sir. Okay. Now, this the insurance industry is a very well regulated industry, and the Insurance Act 1938 and Insurance Rules 1939, they are all pre-independence era act and regulations, but most of them still are valid even today. And subsequently, we have IRDA Act of 1999. In the IRDA Act of 1999, there was one section called 114A, which gave wide powers to IRDA to frame regulations on various issues. And all that they will have to do is to frame regulations and place in the Parliament for their perusal, not even for approval. In exercise of such powers, IRDA has come out with more than 60 to 65 regulations so far in all major areas of operations. In fact, between 2000 and 2002, when the IRDA was at the nascent stage, then Chairman Sri Rangachari hit 4s and 6s only in terms of regulations. All kinds of regulations he came, and he was personally involved in drafting those regulations. Major regulation areas like financial reporting, investments, social and rural sector obligations, solvency margin, reinsurance, and talking about maintenance of records, manner of receipt of premium, agents, brokers, health insurance, reinsurance, micro insurance, you name it, and there was a regulation and extant regulations with all the your formats and all that. What insurers are expected to do in terms of regulation, what kind of compliances are prescribed, everything was mentioned in the regulations. Please, next slide. Why I'm talking about regulations? Because these regulations themselves offer opportunities. The more and more complicated, in fact, IRDA is pretty happy to keep on promulgating regulations after regulations, because every chairman of the IRDA wants to probably excel his predecessor in bringing out new regulations. But there are new areas also. For example, we had recently about this web aggregators. Now they immediately brought a web aggregator regulations. For example, your policybazaar.com and all that, they had to be regulated. So any insurance related activity had to be regulated in a different manner. So regulator came with regulations. But more complicated, more demanding the regulations are, naturally there are more opportunities for ensuring compliances. And ensuring compliance means you have to ensure compliances by only checking on the compliances, but you cannot check the compliances yourself. So you will have to approach. And in this country, there are no other people, in fact, better than chartered accountants do it. But you have to understand one thing. IRDA is very favorably disposed towards chartered accountants at all points of time. We will have to mention one particular, point, very important point here. See, in the board of IRDA, you have ICAI sitting president at all times as a part-time member. No other regulator, like whether it is SEBI or whether it is RBI, has given this kind of respect to the Institute of Chartered Accountants of India at all. So at all points of time, the sitting president of the Institute of Chartered Accountants of India is a board member in IRDA, and that is the reason why IRDA has got a fantastic rapport with the Institute of Chartered Accountants of India, and that is the reason why also more opportunities keep coming chartered accountants' way. We will have to take advantage of chartered accountants, and we need to create opportunities. But as Mrs. Rajeswari was mentioning, you need to know about the subject, which means you have to attain domain knowledge. This is a very, very complicated subject. Insurance is not that easy to learn. It's a very complicated subject. It needs a lot of learning, and it is better to attend. In fact, Institute of Chartered Accountants of India is conducting a post-qualification course on risk management and insurance, and there are other institutions in this country, like for example, Insurance Institute of India based at Mumbai, and Institute of Risk Management based out of Hyderabad. All these things, all these institutions are offering special courses on insurance, and it is probably good and advantageous for chartered accountants to acquire more and more domain knowledge, so that they will be able to even pitch for work and do it better. Next slide, please. So from the regulations, I'm taking certain aspects for the opportunities. Number one is the operational audits. An audit of insurance companies' operations can take different forms. So you have an internal audit mechanism to check on the operational efficiency of the company's shop floor operations. Many insurance companies, especially the public sector insurance companies, have their own internal audit departments who probably visit the operational offices to do this kind of internal audit on the operational aspects, on the procedural aspects, because right from KYC issues, you will have to do a lot of verifications and compliances, especially when you have huge amount of regulations, and the regulations are so strict sometimes. The fines that are penalties that are levied by the IRDAI are in crores of rupees to the member. So it could probably be worthwhile for the managements of insurance companies to have compliance audit mechanisms for various areas of operations. Now, as of now, we have regulator mandated audits only for investment side. On the risk management on the side and the concurrence audit about which, of course, Sri Venkatakrishan and Mr. Vijay Kumar will be talking. But there are other areas which I'm going to be talking a little in detail in the coming slides. There are several issues for which there are operational audits are necessary, and chartered accountants will have to ensure that they acquire enough amount of domain knowledge to enable them to conduct these operational audits. Next slide, please. Claims and OPEX audits. Again, this was mentioned by Mrs. Rajeswari. Claims outgo are the highest expense for any insurer. I will stress it myself to non-life sector, because death claims in life insurance companies, it's different ballgame altogether, because they are giving out of the life fund. In the non-life sector, it's an expense by itself. The incurred claim ratio is as high as 86% of the premium collected. Now, on the procurement cost and management expenses, though they are having statutory limits as defined by the Insurance Act itself, they are also swelling to large levels. In the case of non-life sector, the procurement cost and management expenses are in the region of about 27%, which means total 86 plus 27, we are already reaching beyond 100, which means every insurance company is invariably in underwriting loss, which means they will have to only depend on what is called an investment profit, investment income to even stay in the business. The management should probably be encouraged or suggested to engage professionals, accounting professionals, to do efficiency audit in these areas, so that the expense ratio and the claims ratio and the procurement cost ratio are brought to reasonable level, so that in future at least insurance industry is able to make underwriting profit, which probably they will have to do. Next slide, please. The other offshoot, this is a very complex area, this reinsurance. I'm not very sure that many, even insurance professionals, even people who have been working in insurance industry for a very long time, they do not want to get into this particular area. It's a very highly technical and complex area, because it is a reinsurance basically that that is actually enable the insurance companies to attain to accept more and more risks, because the risks are far wide and spread to the various insurance companies. For example, your match factory in Sivagasi, the premium that it pays to a local insurance company will even go to a reinsurance company in Chicago. So how the whole system of insurance, reinsurance operates in such a complex manner. I mean, it's in a complex web by itself. Long before the term, what is called your international business is there, even long before the term, also these kind of terms were even coined. The reinsurance was a truly international business. Long before the term international business even was coined. The managements of insurance companies would do well to employ extra, because this is an area where things can go enormously wrong. Small mistake can lead to very high, loss position in the insurance companies. So what people need to do is to even there has to be a maker checker process, and the checker should probably be a person who is not in the insurance company by itself. It should be from outsider. You have to probably have issues like RI policy and RI program, the treaties and the conditions thereon, the bordereau that is received from RI companies and brokers, facultative placements, the quarterly accounts that are rendered by the treaty reinsurers, and periodical settlements of reinsurers accounts, reconciliation of reinsurers accounts, profit commission statements, and portfolio withdrawals and portfolio entry. All these things are again highly complex, and one has to know a lot about reinsurance and reinsurance accounting to even be able to do an audit on reinsurers. But I am telling you that there are no better professionals than chartered accountants who can even start learning these things. So it is only and because you need to have an accounting background to even start learning all these things. But we have to take the enough amount of interest in doing this, in learning this, so that we can probably in the future years, these are all the areas that can be tapped for audits of specific domain areas. Next slide, please. ITGC, that is IT general controls. All the companies have gone for end-to-end integrated software, whether it is for right from the underwriting to claims and all that, they have integrated. And there are certain companies which have implemented module-wise software and then integrate them in the back office. The statutory auditors are unable to go and check the programming aspect of them. It is impossible for them, especially when you are given a very short time. These, especially the central statutory auditors, they are not called central statutory auditors in private companies. They are called only statutory auditors. Central statutory auditors is a term that is employed only by PSUs, because normally in PSUs you also have branch auditors. Branch auditors send their reports to the central statutory auditors. Central statutory auditors consolidate them and issue a common report. Whereas in private sector insurance companies, it is only the head office auditors, and they they derive their comfort that every single transaction is captured at the head office level in the system itself. Because even if a policy is issued in, for example, Chandigarh at 10:20 a.m. on a particular Monday, at 20:25 you will be able to see the policy at the head office. So that is the technological improvement that we are having today. But whether the software is right or not, where the people who have designed the software have understood the system, and have they made any mistake, are there any glitches, how do the statutory auditors will come to know? Because the statutory auditors can draw comfort only if a comprehensive ITGC audit is done. Instances of staff, and of course this is responsibility of the auditors themselves, but instances of staff, statutory auditors outsourcing this work to various other CA firms equipped to do this are prevalent today. Which means we will have to understand that where all these opportunities arise and probably try to tap those opportunities. Because the scope will include verification of data security and business continuity planning, disaster recovery, and also online marketing and sales in these days of online sales. Please, next. So as I was mentioning, IRDAI regulations, we have more than 60 or so. And I also talked about the various areas encompassing. Today we have all policyholders protection, capital adequacy norms, obligation to rural and social sectors, expenses of management, advertisement. In fact, IRDAI has come out with regulation on how to make, how an insurance company even do an advertisement. In fact, an insurance company cannot do what is called teaser advertisement and all that. You cannot keep the policyholders in suspense. And if in case you are doing such things, any such thing like this, you will have to, like for example, you have a statutory byline for cigarette advertisement called "cigarette smoking is injurious to health." Like that, the insurance companies are mandated to put a byline. Insurance is a subject matter of solicitation. In case you don't understand that it is an insurance advertisement, they are making it very clear even in the advertisement itself. So how advertisements themselves are regulated. Brokers, agents, TPAs, the third-party administrators for health insurance companies, web aggregators, all these people are all these areas are regulated. So IRDA inspections do take place from regulatory perspectives to ensure compliance of all these regulations, but there is no comprehensive mechanism to check on compliance. I was talking to you on management report. If the company has to give a management report that encompasses all these areas, how will a CEO have comfort in giving or signing such a management report unless he is sure that there are certain professionals who have looked into these aspects and they are able to confirm to me that things are okay. So this is the reason why I'm saying that there is a very compelling need for such audits, and such audits are actually satellite audits of the statutory audit, satellite audits for insurance companies. These audits can be, these are all the areas that can be tapped in the future. And the Institute of Chartered Accountants of India president, who is sitting in the board of the IRDA, also should ensure that the chartered accountants are engaged in a massive way, because this is an industry that is poised for a giant leap. We are talking about a huge leap in the industry. The Morgan Stanley predicts by 2030 India's economy would be 6.4 trillion. And you look at this, as the Jayasimhan was mentioning, madam was mentioning, the higher the size of the country's economy, the higher will be the need for financial sector, and insurance being an integral part of the financial sector, you will have a huge amount of scope in terms of work and assignments. Next one, please. Madam was mentioning about this area. So forensic audits, the frauds in claims and other areas are not uncommon. Especially in insurance industry, there are a lot of frauds that are happening, and a lot of, especially e-commerce frauds are also happening. So you need to have what is called a forensic auditing that has to be taking place in the insurance. Even in the proper, in fact, one insurance company, as far as I knew, employed a forensic auditor to even go through their expenses, because they had a suspicion that the accounts department were fudging the vouchers or probably doing something, and it is not possible for what is called an audit, an ordinary audit, especially statutory auditors who are doing audit remotely in these pandemic times, have to be more concerned about the possibility of fraud, because in this digital era, everything can be altered. Even before the digital era, Satyam Ramalinga Raju was successful in doing a very big fraud. So today, with the the kind of technological possibilities, you can see that so many things are possible. So there is a intense need for what is called forensic auditing, especially in the insurance industry, where moral hazard plays a very huge role. In my view, CAs have the innate investigative skills. They may not employ the investigative skills often, but they have the innovative skills and technical excellence to take up such assignments. Next, please. This is a subject which I really wanted to impress upon: risk management and insurance consultancy. Now, here, the business world itself is wrought with risks galore. And as I was mentioning to you, insurance is a product that is in the push category. Unless a loss hits a businessman, he never realizes the importance of insurance. And he takes insurance only because his banker insists on insurance. And even when there is such funder needs on insurances, they are not taking it properly. For example, if a person takes a loan of say 10 crores, he thinks that he has to take insurance for 10 crores. Now, for taking a loan of 10 crores, he has to probably mortgage his stocks worth of 15 crores or perhaps 18 crores, or probably even give collateral security of something else. Now, his total, for example, his total stock, let us assume that he takes a stock-based loan. His total stocks are say 16 crores, based on which he takes a limit of 10 crores. And he thinks that 10 crores insurance is enough. And the persons who are selling the development staff who are coming, or marketing people who are coming and selling, they're saying, okay, and the bank, in fact, these people are also not going there. The bankers themselves have a tie-up with insurance companies. Immediately they take an insurance for 10 crores and debit the customer for the insurance premium. But when there is a loss comes, but there is a total loss, and if entire 16 crores stock is gutted or lost in floods, what will happen is the insurer will employ a condition of average, which means you will not get the entire amount of loss compensated to you at all. But this is an issue that a banker does not seem to be aware at all, but only a chartered accountant will be able to. So what I'm suggesting is, forget about the opportunities coming from the insurance companies. You will have to create opportunities for out of your own clients. Your own clients are buying insurances. They buy all kinds of insurances. So they buy insurances, for example, motor insurance, stock insurance, declaration policies, fidelity guarantee, business interruption, money in transit, business, all this, Keyman insurance, all these kinds of insurances are being taken at all times by various business people. And in all these things, it is possible for a chartered accountant, the auditors, to step in and ensure that the clients do get maximum insurance cover at the minimum cost. I will tell you one simple example. How many of us are aware that in terms of motor insurance, that no claim discount that is given to you for an accident-free year actually travels with you or the owner, and it does not travel with the car? In getting this particular knowledge, I will tell you how much money that you will save. Let us assume that a chartered accountant himself is driving a Maruti Ertigo car, and he bought it in the year 2010. Let us assume 2015, because 10-year-old car cannot survive. 2015, he has bought a car 2015, and he is been paying a premium, and with all his no claim discount reaching up to 50%, the total premium that he has to pay today is only, for example, 4,000 rupees for this car. Now he is thinking that he has to change to a much better car, so he goes to a Kia Seltos or any other high-end car today that is sold, for example, for about 20 lakhs or so. Now for 20 lakhs car, the car dealer will say, sir, you will have to give a premium, comprehensive premium. The premium will work out to something close to 30,000 rupees. Now you have to pay 30,000 rupees, but you have sold your earlier car in which you are having a 50% no claim discount. What you can do is, actually you can shift that no claim discount of 50% to your new car insurance premium, and what you probably were getting a 4,000 rupees discount there, out of total 8,000 rupees premium, you are getting a 4,000 rupees discount on. If you are transferring to this car, the amount does not get transferred, the percentage gets transferred, and it goes with the owner of the car. So suppose, for example, this car's premium is, say, for example, 25,000 rupees, you get a discount of 12,500 rupees. This itself is not known to even many chartered accountants themselves. But if they do not know themselves, how will they advise their clients? So what I'm saying is, the knowledge about the insurance products, various benefits that are available, we'll have to know. I will give you one more example, a stock declaration policy. I've seen this. So, suppose, for example, there is a textile merchant who, stocks his goods at different levels at different points of time in the year. For example, for Diwali time or Christmas time or Bakrid time, he stocks a high amount of goods. And other lean areas he may not stock. So, but suppose his maximum stock maintenance is, for example, 10 crores of rupees. It is not necessary for him to take 10 crore policy for the entire year. What he can do is, he can do a declaration policy, which means he pays a premium, an advance premium, and he can keep adjusting. He can declare his policies every month, and he can temper his total premium at the end of the year by actually calculating actually the premium that is necessary to be paid, and actually he can save a lot amount of premium that has to be paid. That is the reason why I'm saying that it is chartered accountants who can advise their clients basically insurance consultancy with maximum insurance cover at minimum cost. There are other large clients who are actually bidding for huge projects and huge contracts. They have to factor insurance costs to prune their prune the insurance cost to even do a competitive bidding. For example, if you are going to if your client is, for example, L&T, L&T what's called bids for a huge infrastructure project. Let us assume that airport in the Sriperumbudur. The airport is Sriperumbudur. The total budget is, for example, let us assume that is about 900 crores. I'm not telling you the exact figure. I'm just giving you 900 crores. So 900 crores, you will have to do insurance also for contractors, all this, and they will take and they will have to get quotations from various insurance companies. And when they bid to the government, they will have to add the insurance cost also as their cost. But there are other companies, like for example, other infrastructure companies, they are also bidding and they are employing proper professionals of insurance, and they find out what are all the insurance that are needed to be done and how you can maximize the benefit and minimize the cost of insurance. Suppose you are able to prune the cost of insurance to a reasonable level, you can add that amount of money to the bid so that your bid itself becomes competitive. So these things you have to have, chartered accountants. The other areas which Mrs. Rajeswari was mentioning is about arbitration and claims negotiation, mergers and acquisition, IPO. Of course, these are all at the very higher level of consultancy, and you definitely the insurance companies for such works will probably employ the large chartered accountant firms or the consultancy firms like for example McKinsey or E&Y, or these probably will not hit the normal chartered accountant's office. What I have mentioned will probably hit the normal chartered accountant's office at our level. Next slide, please. I'm almost completing my presentation. Next slide, please. The influence of the information technology in the makeover of the industry. Now you have, as I was mentioning, the customer expects everything at the click of a mouse. Online policies, filing of claims, even getting the money of claims into, for example, you are having what is called prepayment of claims, grievance redressal, everything he wants only in the, I'm talking about the cashless claims, grievance redressal, etc. An insurer always has to balance between the expectations of his customers, dictates of the regulators, changes funneled by the needs, namely, for example, there was insurance was under tariffing for a very long time. The de-tariffing of the industry took place about 10 years back. And the FDI increase, now it was originally 24, it became 49, it is now 74%. And the aspirations of the shareholders, because the shareholders, today, many insurance companies are coming for a IPO. And the normal people get the shareholders, unless they are sure that they will get dividends, which means for getting dividends, the insurance companies will have to make profits. So for making profits, the insurance companies will have to be run efficiently. And for efficient running of the insurance companies, they will have to have complete, compliance check mechanism so that things, the maximum amount of efficiency is attained. Like for example, today you have web aggregators like Policy Bazaar and digital channels like social marketing, media marketing with analytics tools. All these things are influencing the insurance industry to a great extent. In every such area, chartered accountants can become facilitators and consultants. There are huge potential for chartered accountants in all these areas where, chartered accountants, all that we will have to do is to learn the insurance as a subject, because insurance is a very exciting subject, very interesting subject. I have spent all my career, learning insurance. I'm still not done yet. I'm still learning. But I have, in the year 1980, I joined United India Insurance Company. I was actually 2.5 years to 3 years senior to Madam Rajeswari, who was the, who today was a chief guest. And from that period onwards, even after joining the practice in the year 1999, I continued my tryst with the insurance industry, and I have been doing work for the regulator along with my good friend Venkat. We have been doing a lot of things. So insurance is a very exciting subject. Only thing people will have to develop interest in it. And once you develop interest in it, sky is the limit. My next and the last slide, please. So there are growing opportunities, as I was mentioning. Growing domain expertise augmentation is the need of the hour. It's not possible for keep on. We'll not. And as you know, bank audits are shrinking. Income tax representations are becoming faceless, also merciless. GST audits have gone. NAFRA threats are hanging over our heads. We need to explore newer avenues, easier avenues. CA practice is like going up in an elevator that travels the wrong way, escalator that travels the wrong way. You have to keep running even to stay where you are. What I'm saying is, in fact, anything that involves a signature, it is better to avoid. Anything consultancy is something that you can do without much problem. Only thing you need to be sure of what you're advising, and of course you can also take professional indemnity policy for wrong advices. Thank you very much for an excellent patient hearing. Thank you very much.
It was an excellent presentation, sir. More than patient hearing, you arrested the audience. So we should be thanking you for your time and your sharing of knowledge and wisdom. And will you be there till the end, sir, or you will take up the questions?
I have to listen to Venkat.
Yes, sir. Yes, sir. We'll continue with the next speakers. I'll take the pride of introducing both the speakers.
I will have to take revenge on him.
Sir?
I will have to take revenge on Venkat now.
Please do.
I'll introduce
Can I
formally speaker. I'll introduce the speaker, sir, 1 minute. For the benefit of the yes, sir. Profile of CA Venkatakrishan N. He served as an independent professional director of Bharat Overseas Bank Limited for 2 terms of 3 years each, and was chairman of the audit committee of the board. Co-opted member of the standing committee on finance and accounting issues constituted by the Insurance Regulatory and Development Authority of India. Member of the standing study group constituted by IRDAI and ICAI, and authored the checklist on systems, risk and concurrent audit of investments on insurance companies. Co-authored a technical guide on migration audits published by ICAI. Co-opted member of the committee on information technology of the ICAI. Involved in setting up internal audit function and internal control systems at large corporations, India and Sri Lanka. Had an excellent academic record and secured university ranks in university and graduation, all India ranks in all the professional examinations, CA, CWA and CS. So such a great illustrious career he has. I present before you Mr. Venkatakrishan. I also take the pride of introducing Vijay Kumar, CAV Vijay Kumar, promoter, director of Kadit Systems and Solutions Private Limited, a leading IT security consultancy firm since 2001. Co-authored a technical guide on migration audits published by ICAI. Has worked on IT security projects across Middle East, South Asia, Asian and North America. Has been a part of the large IT and cyber security initiatives across industries, including BFSI, tech and consulting services. Has in-depth knowledge and working experience of industry frameworks and regulations such as NIST, C5, ISO 27001, series of ISOs, CSA Star, HIPAA, GDPR, HIT RUS, HITrust, SOC1, SOC2, IT Act India. Had an excellent academic record and secured all India ranks in CA examinations. We have 2 great speakers additionally from now on. Please take over, sir. Over to you. Thank you very much for accepting our invitation.
Good evening and greetings to all. We thank the SIRC and its officials for this great opportunity to be talking along with veterans of the insurance industry. In fact, me and Vijay Kumar are the two people who have not been involved in insurance companies, though we have been working with the insurance sector and IRDA. We have not worked in insurance companies, and therefore all the other three, like Madam Rajeswari and Jayasimhan and PRABHAKAR, have been in the insurance industry. IRDAI is the statutory regulatory body, and just to borrow the expression of Mr. PRABHAKAR, I've heard him say this in one of the meetings. IRDAI develops regulations for regulating developments. Okay, this is one of his expressions, though he did not say it in this kind of a positive tone. I wanted to make it a little positive. Okay, ICAI is our alma mater and a trusted partner of IRDA in assessing compliances with prescribed processes, controls, and the reporting requirements. You would have heard the member of IRDA, Madam Rajeswari, talk on the logic and concepts, and she gave out so much of information about what IRDA has been doing. And Mr. S.N. Jayasimhan is a member of the CA fraternity who has been championing the cause of systems-driven investment operations with layers of controls to make sure that nothing goes wrong, and if it does, it gets detected at the next layer of control. This is how he has designed the investment systems. Risk is a perception, but loss is a fact. And as PRABHAKAR was explaining, the facts appear on the asset side. The loss gets accounted there. It reduces your assets and the perceptions are on the liability side. This is the basic model of the insurance balance sheet. Just to explain some of the risk perceptions which Mr. PRABHAKAR was talking about, I'll just share a small anecdote. There were two businessmen who met at a club. One of the businessmen said they were talking over a glass of drink, and one of the businessmen said, I had a fire in my factory last month. I lost about 3 crores and I got it all covered by insurance. On the other side, the other businessman said, I had floods in my factory for about 3 months back, and I got everything covered by insurance. The first businessman asked the second businessman, how did you organize floods? This is the level of fraud risks that are available on claim side. So, and on the investment side, whatever risks are available, we are going to talk over the presentation this side. IRDA requires and has mandated seamless systems control across various applications. That is what is required, whether it is inter-investment function or intra-investment function. It has to be seamlessly integrated without manual intervention. And IRDA has, through its regulations, achieved this through a well-designed IRMS, that is information risk and risk management system, and concurrent audit, and periodic returns and reporting to IRDA on the investment side. Today we are here to discuss the investment function related controls, and this function constitutes a significant percentage, as you have already heard, of the asset side of the insurance company. As auditors, we normally advocate something called a PDC, right? A preventive, detective, and corrective control system. Or some companies call it CAPA, CAPA, corrective action, preventive action. But the stakes here are so high that the corrective controls can only provide percentage comforts, and it cannot lead to restoration of the old status. That's something which auditors need to understand. People who are doing investment audit or concurrent audit of insurance companies or any other audit for that matter need to understand that the corrective controls alone are not going to restore the comfort levels at the insurance company. Therefore, the preventive controls acquire a lot more importance, and if that fails, a detective control as soon as possible is required. This is something which we need to understand. So, during some of the recent discussions with IRDAI, we have had talks about how far the auditors can rely on management representations, because it is a certification model. When there is a certification model, you are expected to verify and certify. But if you are going to rely completely on management representation, it is not going to be comfortable to IRDAI. And management representation reports should not be bigger than your report as an audit report. That is something which we need to work on. And relying on the work of another professional also is something which we need to tread carefully, because if that professional has relied on management letters and he is working on disclaimers, then we need to be a little worried about it. We need to entirely understand the process which he has gone through, he or she has gone through, and then rely on the work of that professional. And we need to be very careful about our disclaimer statements also. Disclaimer cannot include things like, we have not covered this point in the checklist, we have not covered this point in the, that cannot be a disclaimer. A disclaimer should be, we have done all these things and this is what is our disclaimer. That's how it should be. Okay, IRDAI has mandated the certification model through the ICAI, and therefore the objective of this webinar is to provide insights on the audits and the opportunities it opens up for the fraternity. On the opportunities part, CA Prabhakar has already given excellent details which all of us should make use of. In fact, some of the areas were new to me too, and I'm going to embark on those areas. Thank you. And as two professionals deeply involved in this entire investment audit process, me and my partner Vijay are here to share some thoughts. Vijay will take you through the presentation, and I will chip in with my inputs wherever required. Yes, Vijay, over to you.
Thank you, Venkat, and thank you, Mr. Prabhakar, from the SIRC. I think we've had two wonderful sessions today after the lead speaker, Madam Rajeswari, spoke. Mr. SNJ and Mr. Prabhakar on the role of CAs and on how insurance industry is opening up a lot of avenues for CAs. Having said that, the main component of an insurance company on the asset side is the investments that it makes, and you know, the quantum of investments, as Mr. Jayasimhan said, has reached a humongous figure. It has almost reached 42 lakh crores this year, and the expectation is that in the next few years it will be almost 50 lakh crores, which is probably one of the systemically very critical factors affecting the Indian economy. So investment risk becomes a very important matter that has to be addressed by insurance companies. how do they address investment risk? How do they comply with the regulations of the insurance regulator? And what are the current mechanisms in place to have that? So this is going to be the broad agenda for this session over the next hour. Before we start, I have a small disclaimer that all views and opinions presented are the personal opinions of the presenters and do not necessarily reflect the views of the organization they are associated with, the ICAI or the IRDAI. This is a normal disclaimer that normally make. And there is going to be a start of why risk is going to be very critical in evaluating investment functions. An overview of how risk functions interface with other investment activities within insurance companies. What are the current regulations that IRDAI has for the risk management of investment functions? And lastly, we will touch on the technical guide that has been issued by the Institute of Chartered Accountants of India to do this investment risk management systems audit, which we call as the IRMS audit. And why is, first of all, investments such a critical area? Because normally when we talk of fraud, the first thing that comes about to mind is claims fraud or policy fraud, dead man claims or dead man policy, fraudulent claim processing. But these are actually very, very small and insignificant losses or frauds when we compare with the quantum or the volume of investment activities. And if I can probably give an analogy, there is a joke that has been circulating on WhatsApp over the last few days about how a board has a proposal. The board of directors of the company have a proposal where there is an investment for a power reactor for 1.5 crores and a bicycle stand for 2 lakhs. And nobody understands anything about the power sector. So they all approve the reactor in about 5 minutes, whereas a bicycle stand gets discussed for about 1 hour on the session. So this is something very similar, because the quantum of investments of even a very, very small new player in the insurance industry, we would be talking of something like 20,000, 30,000 crores, which is like an enormous amount of money compared with a claim which would not even exceed probably 10 lakhs or 20 lakhs. So there we go about understanding why investment risk is very critical. And again, it is not as though this is an hypothetical risk area or a fraud area that we don't need to focus on. History has taught us that some of the biggest incidents on trading fraud or investment fraud has happened in investment and treasury. We all know about Barings Bank. This is almost 25 years old now. I think most of us would have probably been reading about it. There has also been a movie that has been made. Nick Leeson, who was involved in that Barings scam, also came up with his own autobiography. But these are some facts. I'm not going to run through the facts because all of you can just go to Wikipedia or just type Barings Bank Nick Leeson and you can get all the facts. But what happened was, one, there was unauthorized trades. There were losses that happened with these unauthorized trades, and he hid all these losses into some trading accounts, error accounts as they call it. Nobody reconciled those error accounts. And when he started seeing that nobody was reconciling those error accounts, he started doing more losses, parking more of those money into those error accounts. Basically, he started covering up a number of mistakes. And so finally, the game was up, and Barings Bank almost had to close down. I think they actually closed down with a huge amount of losses. But one more critical systemic failure there was that the management had allowed Leeson, who was the perpetrator of this fraud, to remain general manager and chief trader, while also being responsible for settling his trades. So there goes all the segregation of duties, functional responsibilities, mid office, front office, back office, all that we spoke about. And it is debatable as to how much money Nick Leeson made, but he didn't really make those $2 billion. He just made a couple of million more as incentives from the management rather than having benefited from the fraud. And this is not a one-off case. A couple of years back, we might have seen about SocGen, again a 3.7 billion euro fraud. And the modus operandi was more or less same. The transaction started relatively small. He again tried to conceal this activity by doing something else. Again, whenever the fake trades were questioned, the person who was involved said that it was an error, and then he canceled the trade and then did something else to rectify the situation. But somehow the interesting thing here was he actually understood how the bank's internal control system worked, and he was able to bypass this entire internal controls, because internal controls basically looks at something that actually has a spike, a transaction that passes a particular spike. As long as transactions go within a particular range, nobody actually looks at transactions in greater detail. That's what we all call as sampling methodology. There is a how to do sampling, how to pick up samples when we do audits. So this gentleman exactly understood how the internal controls work, and then did trades which escaped detection. And also he was doing it in just about 2-3 days, just before, they have a system where every weekend they have to do some reconciliation. He ensured that by every weekend he will close the account, on Monday take an open position. The result was that they ended up with some $3.7 billion euro fraud. This is another case, again, same thing, entering information. Here he exceeded the bank's per employee trading limit of 100 million per day. He was like investing huge amount of funds in the market and losing heavily. And these are some numbers that we are talking of. SocGen is obviously top of the list. It's about $7.2 billion. Then UBS, Barings, JP Morgan, 6.2 billion. The JP Morgan I have marked in red, primarily because we're not going to see the modus operandi, but we are also looking at what actually they found out when they did the JP Morgan investigation. And actually, it will be interesting to note that none of the employees of JP Morgan were actually indicted by any court or any investigating agency. They just said that the CIO's judgment and execution was poor. They did not, the firm, that is JP Morgan, did not ensure that the control and oversight of CIO was adequate with regard to the complexity of transactions that they were doing. The risk management was ineffective. These are large systemic governance failures. Risk limits for CIO were not sufficiently granular. They had probably kept $1 billion for him when, as per the board authorized limits, he must not have done more than 100 million. Approval and implementation of CIO controls were inadequate. So if you look at this, these are all purely systemic governance issues which has resulted in such huge fraud. And what we learn from history is that people don't learn from history. And history repeats itself because men make the same mistake. If you look at a common thread across all these 4 incidents which I have presented, and these are just not 4 incidents that we are talking of, because this is the entire universe of incidents. Please take your time, go to Google, just put trading frauds by investment bankers. And there is an entire Wikipedia page which is dedicated to this. There are more than 50, 60 frauds that have happened, and numbers ranging from a couple of billions of dollars. The biggest one obviously is SocGen, which has happened because SocGen is big because it just happened a few years ago. I think for the coming decade, we'll have something that is bigger than SocGen. The reason is primarily because, as Warren Buffett had said, that we don't learn from our mistakes. And let's not be under an impression that all these frauds happen only in Western countries or Western economies, which have highly complex instruments, and India is fairly insulated from these kind of frauds. We already had our Satyam case, which again involved, some kind of falsification of accounts, some kind of forged bank documents. We had a PNB which had 11,400 crore, and which was a very simple thing actually. Though there was a lot of again systemic failures, governance failures. Nobody knew that a SWIFT interface had to interface with your core banking system for guarantees given by the bank. So eventually the bank was woke up one fine day to find that they had 11,400 crore outstanding guarantees to be provided for. So all these things point to the fact that, well, yes, insurance fraud generally brings us to the concept of a claim fraud happening, some person who did an accident of a car while driving but claims it's an insurance and gets 10,000 rupees, that is a fraud. Or some person who takes a policy on a dead man, which is a very common thing. Now, of course, with all the KYC and all that, dead man insurance is that much more rare. But earlier, it used to be a very common fraud. But we are talking of very, very small sums, very, very small amounts that we are talking of. These are huge amounts, considering that we are talking of lakhs of crores of investment that we are dealing with. And one more thing we have to understand is that the threat landscape has totally changed in the last few years. There has been an increased use of technologies. There has been a lot of systems that have started playing with each other. As we talk today, I'm sure a lot of you have known about an incident that happened with a logistics service provider. There has been a ransomware attack on a logistics service provider, which has impacted large companies from I'm sure you would have come about the Kaseya's incident that happened a couple of days ago. So we are not just looking at insider breach, because whenever we talk of threats, yes, insider threats are very significant. A person with full knowledge of how systems work, how internal controls work, is always going to find out a loophole in the systems. But yes, over the last few years, there has been an enormous increase in the kind of cyber threats, if I can use that word. Ransomware, trojans, malware, with all the kind of remote working that is happening last 2 years. Imagine you, an insurance company, building up an entire controlled dealing room. And last 2 years, the dealer has been sitting at home and doing his deals, where he's probably sitting in the privacy of his home inside his bedroom or a study room, and you don't know who's sitting next to the dealer. In a typical office environment, we might have had so much of controls that he must not take his mobile phone inside the dealing room. Nobody is allowed. He's got a web camera which is always focused on him. But all these controls that have totally been, let us say, compromised in a remote working environment. And social engineering, this is a huge threat as far as we are, it is emerging, because people give out their credentials, they click on emails without verifying the senders, and these cause huge threats in organizations. And this is some numbers which has been reported by the government of India, that last year on the banking sector, there was like 2.9 lakh cyber security incidents. And I'm sure you must have heard about the Bangladesh bank, and there's a YouTube link as well. Maybe you can just take your time to go and view that particular link. But it's a classic case where an employee within the bank just clicked on a mail from an unknown source, and that itself manifested into a huge loss, almost a $1 billion loss for the bank, which finally they were able to retrieve some amounts. But finally, the loss came to about $81 million using the SWIFT platform. So what we are learning, if we look at all these incidents, which is going to be the direction for what I'm going to talk over the next remainder of the session, is that yes, most of these have been internal incidents. With cybersecurity, of course, they may no longer be the case. But yes, all these incidents have been done by people who know the systems, who know how things work. All these have resulted from systemic governance failure. It is not as though these organizations are small or very small organizations run by 2 people or 3 people. These are large MNCs which have employed consultants and which have employed top-notch firms to build processes and frameworks. And at the end of the day, you have systemic governance failures. Thirdly, yes, every fraud perpetrator starts small. Nobody tries to loot a couple of thousands in his first attempt. He always starts small, tries to look at whether someone is finding him, and if nobody is finding what he's up to, then slowly he starts increasing the ticket size. Finally, when it becomes a huge ballooning figure that he can no longer suppress. One other thing when it comes to investments and insurance is that it may not always be a fraud from a typical sense that someone is actually trying to make money out of it. It could also be a case where, because of the high pressure that the industry investment managers operate in, it is a very performance-driven industry. They have to get performance incentives. The fund managers, the CIOs, the performance of the investments is a reflection of their performance, and they are driven to taking very risky positions. Though when I say risky, all this has to fall within the regulations, but still they could be tempted to take risky positions in the hope that they can make more returns for the investor, but they may end up losing a significant portion of those investments itself. And there's an old saying that the thief is always one step ahead of the police. And if we have to use the same analogy in an auditing parlance, we have to say that a fraudster or an internal control breacher, if I can use that word, is always one step ahead of the auditor. Because auditors typically have pressure. We come, we of course sign, Mr. Prabhakar said, as long as possible, avoid signatures, but I think more regulators are trying to get CAs to affix their signatures on every single piece of paper, and the pressures and the competition and everything makes CAs accept a lot of engagements. But fraudsters eventually look through this and then try to breach the controls and the audit programs. Before I probably go into how the framework for managing risk in investment actually happens within insurance companies, I'll probably take a few slides to explain how investments are actually structured, so that you can all appreciate how the control framework has also been suitably designed in line with the structure. In any investment function within insurance, or probably even banks, or wherever there's a huge volume of investments happening, you will have three basic three-walled departments. One is the front office, where investment decisions are taken, the mid office where risk management happens, and the back office where there is accounting and settlement. The front office is controlled by the CIO. The mid office and back office could report to the CFO, in which case there will be a separate chief risk officer who reports to the governance and management, or the risk could report to the CRO itself. But CRO as a function would report independently to the board and to the management. So this is how the structure would happen. And what does the front office do? Their job is to basically look at the investment policy that is approved by the board, implement the investment policy, manage with dealers. There's a huge ecosystem of people who deal with the front office. You have brokers, you have there's a Reuters screen, there is the information feeds, there is the research reports. They have to go through all that. There is a structure of dealers, there is a structure of fund managers. If you buy an insurance policy, you'll see who's the fund manager. You can always look through that. You will find out that this fund manager is managed by XYZ. So he's managing your fund. And there are analysts, there are researchers who actually take decisions on how investments should happen. They have to understand what is the cash flow requirements, because as Venkat said, there is a cash flow computation in insurance, which is itself very complex, because what is a liability is an actuarial figure. Nobody knows the liability. It is just that some actuary comes and says that if it is a life insurance company, based on the policy profile, we expect that 10 people will die and you may have to pay 5 crores as claims. This is the kind of actuarial valuation that comes in, and you will have claims to be paid, you will have expenses to be paid, and new premiums would have got collected. Their allocation has to happen. So at the end of it, there is a separate team which looks at what is the cash available for investment, and that investment has to be deployed into different instruments. And there a big challenge comes in, especially for insurance, because when a risk is underwritten, for example, when a life is underwritten, an insurance company would normally underwrite life for say 30 years. A person who is at the age of 40 would take an insurance policy till his age of 75 or 80, which means for 40 years, you have to underwrite his life, and you have to basically do investment on instruments which have that kind of gestation period. Now, instruments which are very actively traded would be instruments only which are like 2-3 years to maturity. If you are looking at instruments like 2045, 2050, these would be very few. Only some government auctions would come in. So they have to find out what is the mix of investments that has to be made. They have to ensure that again they have 6% minimum return they have to give. There is some bonus that has to be provided. There is a minimum guarantee that has to be given. They have to ensure that the performance funds are in line with that. Lastly, they have to take ownership for all the investment dealing. They have to monitor day-to-day movement of markets. If they are invested in equity funds, equity shares, depending on sectors, if bank sector is going to be impacted, they have to do some kind of investments, offloading in bank sectors. And with all this, they have to also look at what are the limits that are placed by IRDA. IRDA has sectoral limits. They have instrument-wide limits. If you go through the IRDA circulars, the limits itself runs to about 20-30 pages. So these are the number of limits that IRDA has created for investments by insurance companies. So the front office job is to basically do all this in line with that. The most critical function is actually the mid office, because he is the person who is actually supposed to do the risk management. First of all, he has to check whether the securities that can be dealt with the front office is an approved security, creation of limits, how much can each person deal with. Typical ticket sizes in insurance companies would start at about 25 crores or 50 crores. A fund manager would be able to place an order for about 50 crores. A CIO can place orders for say 500 crores. Again, these would be different. LIC might have the same limits at 2,000 crores. So LIC's daily investment limits would be in the region of 10,000, 20,000 crores. So if they put 50 crores as limit, they would not be able to put a transaction. So these are entirely customized to individual insurance companies. Then I said IRDA had limits. For example, let us say there was a market breach. Let's say one particular fund had a 10% investment in banking stocks. That was the limit prescribed by IRDA. And suddenly bank stocks went up by 10%. So end of the day, when they do the limit checking, they might see that bank investments have actually gone up to 12%, whereas IRDA limits are only 10%. So next day, that correction has to happen. So mid office has to tell front office that due to market actions or market forces, there has been a limit breach, and you have to offload bank stocks to the extent of 2% so that you can come again within the IRDA limits. There are a lot of SOPs. The best part or the comforting fact is that investments are highly regulated within insurance companies. There are SOPs, there are approvals to be done. IRDA is always on top of them with circular guidelines, forms to be submitted, and so on. But then they also, the mid office also has to look at personal trading, because dealers, fund managers could also do personal investments, and they have to make suitable disclosures when they make personal investments of their own investments or their wives or children. So these are some functions, especially credit risk management is again, for example, there could be some insurance companies which does term loans. So there is an NPA. Typically, like banks, you have NPAs, you have non-performing assets that could come in. They also look at deals, prices of deals to see if there is a variation, whether previous price and current price, because generally insurance investments are not very actively traded. So they always look at whether a price point or a price difference is very high. So these are some functions of the mid office, more as monitoring and risk and compliance. The back office is typically the postmortem for all activities. They do settlement, ensure that the bank funds are received and paid out to the brokers. There is a reconciliation with custodial records. Typically, custodians are people who hold like NSDL, CDCL. They'll have custodians who hold the securities on behalf of the insurance companies. So they will do a daily reconciliation of custodial records with their investment holdings. There could be corporate actions like some rights issues, bonus, dividends, interest payouts. All these has to be checked. And one critical function that comes in the back office is the NAV declaration, because the NAV is especially for fund-based policies like ULIPs. NAV declaration is the step by which the next stage units are allocated. So that's how the cycle for insurance gets completed, that the policy tells what collections has come in. And at the end of the day, investments tells what is the NAV to be applied on new investments or new policies. So these are some functions of the back office. Of course, they are also looking at what are the returns and reports to be given to the regulator, some audits to be done, the accounting for investments, derivatives. Derivatives are very, very complex instruments that can be used only to hedge risk. And the accounting policies with regard to derivatives has to be in line with the regulations and guidelines of the Institute of Chartered Accountants of India. So the hedge effectiveness test, whether the hedge is effective, what provisions have to be made for ineffective hedges, all this has to be done. Now, the investment function, there are basically four major entities. One is the people, which is the CIOs, the CFOs, the chief risk officers. You have dealers, fund managers, risk managers. Each one has a particular role to play within the investment activity. There is a process which is board approved process, relates to standard operating procedures. There could be investment policies. There could be accounting policies, derivative policy, risk management policy. There are at least about 15-20 policy documents to establish a governance structure within the insurance companies. And without the support of technology, it is impossible to run investment operations within insurance companies. They need very strong applications, like you have investment applications like M-Fund or Credence or SAP to run their investment operations. They have dealing systems which interface with brokers, Reuters screen, which actually gives them market updates, accounting systems, which could be the core accounting systems. So there is a huge technological dependence on the investment function itself. And there are external entities, parties with whom the insurance companies deal with, like brokers. You have market participants, if it is debt deals done on NDO platform. You have custodians, like I mentioned, NSDL or CDCL, the bankers, other internal departments such as policy admin, actuaries are also an external entity as far as the investment functions are concerned. So these are an ecosystem of how investment functions work. And this is an extract from the technical guide. And if you look at this, this is how an investment application looks at. So you have like a policy admin system which talks about unit movement. You have cash flows that come into accounting, the NAV that gets computed from investment applications. Then you have dealers who interface with deal tickets. So everything is in this single application, what we call as the investment application, which is the backbone for this entire investment system within an insurance company. and the investment system has to have limits which are configured as per IRDA regulations, as per internal limits, as per product brochures which they have shared with policyholders. So everything is done within this application. So how does the regulator actually manage the risk? I think this was already covered by Mr. Jayasimhan in great detail when he explained the framework of how IRDA and ICAI works together. But just as a recap, I'll probably say that IRDA has issued investment regulations. There are also an investment master circular that has been issued in 2016. There are a lot of amendments, circulars which are available on the IRDA website. Just like RBI website, you can go to the IRDA website and get the latest list of amendment circulars. Considering the threats from cybersecurity, IRDA has also issued certain cybersecurity guidelines for enforcing cybersecurity within insurance companies. Now, these regulations provide a great level of insight into how investment functions have to be organized within insurance companies. There are also monitoring mechanisms that should be put in place. A lot of controls are prescriptive, which means that IRDA very clearly says that investment must be done which falls within this particular boundaries. So these are very prescriptive controls that IRDA actually prescribes. And what is the role for CAs within this risk management is that there is a risk management systems and review which is prescribed by the investment regulations. And there it is very clearly mentioned that there has to be an investment risk management and process audit, which shall be certified by a chartered accountant. And this shall be done once in 2 years. And from the master circular as well, there is a risk management along with concurrent audit, depending on the assets under management. Today we are talking of 1,000 crores, and most insurance companies today have more than 1,000 crores. So every insurance company has to have an IRMS audit once in 2 years. And whatever happens, so these are the technical guide created by the CA Institute is used as the framework for conducting these audits. Also, there is something on derivatives. When an insurer takes derivative positions, first time he has to ensure that he has the necessary systems in place to ensure that derivative transactions can be undertaken by them. This is very critical because IRDA is very specific that derivatives should be used only to hedge risk, and there has to be an underlying asset when a derivative transaction is entered into. So without an underlying asset, an exposure to derivative transaction should not be there. So there has to be a systemic link between an underlying transaction and the derivative that is used to hedge the transaction. So these are some checks that we have to do as part of the derivative components when it comes to that. So all this is covered by the technical guide on IRMS, which is issued by ICAI. This is undergoing revision. There is a new guide that should come out hopefully the next 6 months or a year. And the new guide would consider a lot of regulatory updates and changes in the business environment and the cybersecurity threats as well. But currently, this is the guide that is available, that is issued in 2013. So members can always access these resources from the Institute's website and go through that. What it covers is that it gives an overview of the insurance industry and so on. But the most critical aspect is the annexures. The annexures which are used for doing the audit of IRMS. These are very exhaustive, running into a couple of pages. So these are the basic frameworks and checklists that the auditors have to use. Now, briefly, what it covers: one is risk management, ensuring that whatever IRDA has mentioned as part of its investment regulations and circulars is complied with by the insurance company. There's a review of the application. As I said, the investment application is something that is the most critical and the most significant point of control in terms of investment activities. So the application has to be tested whether it is in compliance with the regulations, internal policies, and the limits which are tested by IRDAI. The security policies and implementation, how it manages ITGC controls, how the capacity is managed, disaster recovery backup, because there have been instances when, like during Mumbai floods or other incidents, insurance companies have not been able to operate their dealing rooms or investment activities, and they've had to resort to their backup facilities located elsewhere to resume their normal operations. And then there also has to be some kind of vulnerability assessments, penetration testing, ensuring that applications are change management is correctly done, because most of these are third-party applications procured from vendors, and these people release patches based on changes in regulations, or if there's a new regulation which says that and a new control has to be put in, that short sales will not be allowed, or some XYZ control is there, then the makers of these applications will build in that change in logic and then give it to the insurance company, who will have to test it and then do a round of vulnerability assessment, scanning, and then deploy it on production. So these are some of the scope that is covered as part of the investment risk management. These are some of the list of controls that require to be implemented. I'm not giving the full list of controls. The full list of controls can be seen from the technical guide as well as the checklist and the guidelines. There are very strict governance structures which are established within insurance companies, like the role of CIO, CRO, CFO, then how data has to be interfaced with different systems. The movement between front office to back office has to be seamless. There cannot be two applications used, for one for front office for dealing and the other for back office for settlement and accounting. There has to be an audit trail at every point, which means that the system should log who was the creator, who approved it. There has to be a maker checker at every point. There has to be offsite processing capabilities in terms of business continuity, especially to compute NAVs and publish NAV figures. A lot of controls are prescribed on dealing rooms, like voice recorders, CCTVs, not giving telephone access to dealers, the kind of controls that are deployed on their screens, and so on. Then how does limit breaches get recorded? How are they addressed? How does mid office actually look at limit breaches and escalate this to front office for resolution? A lot of times net asset valuation depends on the valuation of the underlying security, which means that security could be downgraded, upgraded by the rating agencies, and based on that, their valuations might change. So these are some of the requirements from the system. So IRDAI's expectation is that the system should be able to do all this without need for a manual workaround or a manual process. So the technical guide, there is an Annexure A, which is generally a one-time activity. This is to be used when a new insurance company wants to commence business. This is to ensure that they have the necessary systems and process to start activities. But on a 2-yearly basis, Annexure B, C, and D is what is critical. Annexure B is for how the standard operating procedures are created within investment operations. It relates to the design of controls, how controls are designed in compliance with regulations. So there has to be an investment policy, derivative policy. Like I said earlier, that there are a number of policies which are part of a governance structure within the insurance company. So there are accounting policies, front office procedures, backup procedures, mid office risk management procedures. So there are all these together form a governance structure which have to ensure the transactions fall within the regulations and the permitted nature of regulations. The auditor has to check whether the design of controls is in line with IRDAI circulars. So this is where his role is with Annexure B. Annexure C is purely on ITGC. Here the controls are more recommendatory, unlike Annexure B, where IRDA's controls are very prescriptive. Annexure C controls are left to individual companies because each one may have their own security policy, their own password strength requirements, their own network security requirements. But then IRDA largely has mapped these controls to 27001 and NIST standards. And the expectation is that there has to be an information security policy, there has to be something about organizational security, asset controls, HR controls, physical environmental security, communications, access controls to applications, operating systems, BCM measures, application control, and so on. Annexure D is where the investment application that is part of the investment function is evaluated. Again, each of the regulatory requirement has to be part of an application control. If there is any manual control or any manual process that is done outside the application, this has to be escalated by the auditor and reported as a non-compliant point. So apart from the expectations of the regulator in terms of what controls an application must exercise, there are also a lot of regulatory investment limits, internal regulatory limits that are configured in the application. And before a transaction is put through, in case it is likely to breach a limit, the application should stop it. Application should not allow the creation of a transaction which is likely to breach regulatory limits. This is the wording that the IRDA regulations actually state. So these have to be enforced through the application. So the objective of this annexure is to ensure that the investment regulations, internal SOPs, and the application are all synchronized and they all talk in unison from a control perspective. Now, a question might come: what is the difference between a concurrent audit and IRMS audit? Because they seem to have a lot of overlaps in terms of the scope. But essentially, the difference is that a concurrent audit is an audit of transactions, whereas this is an audit of systems for compliance with the regulations. The concurrent audit looks at how effective a particular transaction is in terms of compliance to controls, whereas a systems audit looks at how the controls itself are designed. So this is a periodic review to calibrate the systems and ensures that the systems and the SOPs are in line with regulations. The concurrent audit tries to see more of erroneous transactions and fraudulent incidents. Again, the IRMS ensures that, or rather the scope of IRMS is to see that the IT environment, SOPs are strictly controlled and risk and fraud from these are minimized. So it is more of a design audit rather than a control effectiveness audit. And that is the essential difference between the concurrent audit and IRMS audit. So these are some of the things that an auditor must do when planning for the review. Understanding something about the investment functions, where they are carried out from, who are the CIOs, CFOs, where are the dealing rooms, where are the backup locations, what are the new products, funds, and so on and so forth. So these would give a good insight to how to plan the audit. And based on experience, I'll try to explain about some issues that we have come across in insurance companies. And these are not, I'm not going to refer any names here, but what we have found is that in spite of such rigorous regulations by IRDA, a very designed control system, control framework that is implemented as part of the regulations, when it comes to actual ground reality, we find that user IDs are being shared between users, sometimes within front office, sometimes between front office and mid office and back office itself, which essentially negates the entire control. There are no limits set in the system. They are saying that, we never deal with more than 100 crores. Sometimes they say, we'll never deal, so we have not set these limits. These are typical governance issues that come, like I said earlier, history repeats itself. So We have again seen where a CIO has blanket permission to deal with any amount of investments that he can do. Sometimes you have two users, one user having two user IDs, one in back office, one in front office. Because they say that, okay, yeah, because he does a wrong transaction in front office, the back office guy spots it, he has to go to front office and rectify it. So these are issues that essentially strike at the root of this entire mechanism that is created. Then we have backend access, the typical issues of what we have faced in banks. Someone goes through, all the controls that we have put it in the front end, and someone goes to the backend, changes in the database, and comes out without an audit trail. We have seen that investment flag statuses have been changed on the backend, and there's nothing that the front office has no clue about it. We also have instances of non-automated application interfaces. People still download Excel sheets, upload into another system. Custodial records are Excel is probably the investment application that is used more than any other investment application in insurance companies, because we have seen NAVs to be computed on Excel. So these are kind of, and you go and ask them, why are you computing NAVs on Excel? The answer would be that the investment application's NAV is wrong, so we are computing it on Excel. Then you have wrong parameters in application. Like I said, there's a cutoff time issue. Cutoff has to be happen at 4 o'clock, whereas your application cutoff time is set at 1 o'clock. So it is considering all premiums received up to 1 o'clock as to be applied for that NAV. And people who invest between 1 and 4 lose the benefit of 1 day's NAV. So these kind of errors have actually happened, and that we are reporting. Venkat, you want to add some other issues here?
No, carry on, I think.
Yeah. So a quick summary is that what we all have to remember is that investment functions in insurance companies handle huge volume of funds. These are not, an average ticket size is 50 crores, 100 crores. The cost of errors are very high. We are not just talking of fraudulent transactions here. An decision to buy something instead of sell something could cost an insurance company a couple of crores. In fact, we have audited some insurance companies where frauds have happened using investments where a dealer actually colludes with an external agency and makes money. So these are things that are happening, and like I said, there is a huge performance pressure, and the intention to defraud may not be there, but the intention to deliver on performance is something that is driving insurance employees, fund managers, and CAOs to sometimes bend the rules. And when those bending the rules happen quite often, that's when the risk starts increasing. From a regulatory point of view, I think IRDAI has been very prescriptive in controls. In fact, the feedback from insurance companies has been that IRDAI must actually tone down its prescriptive controls and leave a lot more to the insurance companies to manage on their own. But yes, currently the regulations are there. The mechanism on how those regulations are implemented, how these are controlled, and how these are designed and operated is what the scope of this IRMS audit is. Venkat, you have anything to add here on this section?
No, I think you covered all ground. Thank you.
Okay. And lastly, this is the last slide that I have. What an IRS auditor must remember is obviously one is, like Mr. Prabhakar said, take the insurance for professional liability and ensure that you don't sign as far as possible. I'm joking here, but yes, the most significant risk is that IT threats landscape is constantly changing. So while we audit, the risk of incidents happening because of a compromise of systems, which are not entirely within an investment domain itself. It could be a compromise of a system which comes on a policy admin side, but that has an impact on how an investment control could be breached. And today, let me tell you, the kind of third-party interfaces, managed service providers, the kind of ASPs that connect to insurance systems, nobody has a clue. If you ask an insurance company how many ASPs actually connect to your systems, I can tell you most IT companies, most IT managers in insurance company don't have a clue. So these are huge risk areas that that need to be addressed. And yes, insider threats are very critical. People who have knowledge of the systems, who are able to do a transaction, are the ones who are most likely to cause a fraud or an erroneous transaction. And let us face it that any control system will weaken over time. All that we talk about, governance failures, systemic failures, are not exactly a result of poor design of controls. What we actually see from my experience, or Venkat can also share here, is that when a control system is there over a period of time, both the auditors and the auditees get used to a certain level of performance, or let us say a certain level of expectation that comes about in the process. So, and that's when the erroneous transactions or the frauds start happening small before they balloon up in size. So we have to remember that any control system will weaken over time, and just like there has to be a rotation of staff within insurance companies, even audit staff have to be rotated. This is something that I think so, because when an audit staff does the insurance audits repeatedly, there is a very high chance that he might actually start expecting and get very routine with the kind of checks that he may start doing. And I think Prabhakar mentioned or touched upon this, that insurance proficiencies are very scarce. We have like more than 10,000 banks, including cooperative banks in India, but we have a handful of insurance companies, and proficiencies are scarce. Business requirements means that you will not get enough people to actually do functions. So we have cases where a CIO is sitting on the same job for more than a decade. A fund manager sits on the same position for more than a decade. There are no rotation of dealers. One thing that we have been discussing as part of a control measure is that, at least because most insurance companies are funded by other large financial houses like banks or mutual funds and so on, could there be a case where these front office people could rotate within those group companies? That is something that that is being deliberated, because getting one person from an insurance company to have employ more than one CIO or more than a couple of dealers may also not be very viable, considering their number of trades. They don't trade that much, but the volume of trades are very high, the quantum of trades. And lastly, I think the chain is only as strong as its weakest link. So while we can build as many processes, as many controls, and as many regulatory directives, a smallest weak link anywhere in the chain could cause the biggest compromise with regard to insurance investment and risk management. So this is all I have now today for the presentation. So I hope there was an insight into how investment functions are organized, how the investment risks are and threats are very significant, and how IRDAI and ICAI have managed to address these risks. Thank you.
Thank you, sir. Sir, 1 minute. So I will share my screen. So we have some 2 to 3 questions. We'll take it up if possible. So is my screen visible?
Yeah.
So from second on.
First question is whether insurance sector is enrolling CAs for fraud and investigation of claims. Please guide how to enroll. I'm not sure on this. I think it's a question that has to be addressed by IRDAI. But yes, there is a fraud and forensic course within the CA Institute, and I think the fraud and angle is being covered as part of that. But claims is a different area altogether. We are looking at investments in this present discussion. So there, yes, there is a lot of forensic and fraud and data analytics that come into play in analyzing investments and finding out investment breaches. So I'm not sure of any specific course, but Mr. Venkat or Mr. Prabhakar or Mr. Annaraj can add and let me know if there is any specific course for fraud and investigation of claims specifically.
I think as of now there is no such course, sir. It may be part of the insurance course itself.
Yeah, so there's another question that's saying that I'm an insurance surveyor for more than 30 years and I'm doing surveys mainly for losses under miscellaneous policies. If I'm correct, I'm the only CA in Madurai doing service. Whether any new CAs are being surveyors nowadays, I don't know.
Actually, there were in earlier days, chartered accountants were given insurance survey licenses very normally. IRDA, because insurance licenses, survey licenses. But what happened was there was an institute that was specifically formed for Institute of Insurance Surveyors and Loss Assessors, and the power of granting licenses to that went to this institute, and they had very strict norms. You have to undergo an examination, undergo a training under an insurance surveyor. So what happens is, even for those miscellaneous department work, like for example, money in transit or banker's blanket policy or fidelity guarantee, all these domains specifically were surveyed only by chartered accountants. Even for getting these survey works, now it becomes necessary for those people to apply for the license from the Institute of Insurance Surveyors and Loss Assessors, but for which you need to undergo an examination, and you also need to undergo a training under it's like an articled assistant once again. And I don't think senior chartered accountants are willing to do these kind of training and all that. That is the reason why there are new chartered accountants are not coming for as surveyors in insurance sector. The empanelment and how the concurrent and statutory audit empanelment, there is nothing called empanelment for it is, see, most of the companies, for the public sector companies, it is CAG appointments, statutory auditors. Whereas for concurrent auditors, whether it is for public sector or for private sector, the concurrent auditors are only appointed for the purpose of investment function. Only those things, only the managements appoint. So there are strict guidelines, strict parameters, eligibility parameters for chartered accountant firms, which are available in the website of IRDA. And if you think that you are coming under these parameters, it is possible for you to approach the company itself or write to company saying that I am a person who has been seen. What these people are asking is, you need to have some kind of a experience in treasury audit. For example, there are bank audit people who are doing bank statutory auditors. These people are having enough experience, more experience in conducting treasury audits. So these people can, definitely apply for these concurrent audits of insurance investments of insurance companies. And it is only the management that is it. In fact, normally managements, there are certain company managements, put it on their website and ask for kind of tenders or quotations. And otherwise, there are the usual method of lobbying. That's the only way to apply for empanelment and all that. And IT managers, I think this question I will probably leave it for Venkat or Vijay to answer.
Yeah, so the question is that IT managers do not know about API and what is the control mechanism. Yes, this is a very significant threat of late because of the number of managed service providers, or with the advent of cloud technologies, a lot more companies are moving to cloud service providers, and where they give infrastructure or software as a service. And these require insurance companies to open up their systems and their applications to receive data using APIs, which is an automated kind of programming interface. Now, these pose a significant threat primarily because, one, of course, the business functionality and the business requirement is there. But first of all, whether the service provider has done an audit of that application, the API interface that comes into and interacts with the insurer systems, whether these have been subjected to some kind of testing, security testing. These are very critical because technically you could have a compromise in a service provider system which could impact your systems. So the first thing that an insurer has to ensure is that any API that comes and connects has to be subjected to security audit. And this is not a one-time security audit because applications, web applications, interfaces keep changing over time. And these security practices also need to be implemented at service provider locations and at periodic intervals. From an insurer side, there has to be a review of their firewalls, the connections that they have permitted, so that even if a contract with a service provider is no longer subsisting, at least those connections and APIs can be stopped at an entry level. So these are some controls that can be implemented by insurance companies to address the growing, I wouldn't say threat, the risk of exposure from APIs and interfaces.
That's it.
Those are the questions, sir.
Those are the questions.
Yes, sir.
Sir.
Shall we conclude, sir?
Selva, is there any question?
Not much. No, sir.
So shall we conclude,
Thank you so
sir?
much, sir. I request Manaraj sir to propose a formal vote of thanks.
Yes, thank you. It was a great learning for the day, sir, because this is a sector, as rightly pointed out by Prabhakar sir, not so keen subject for members to enter into it. And because it has so many intricacies and so much of volume, both are there. But the difference between the opportunities and what's called avenues, this is the distinction you gave to expand our what's called the areas of operation for professional chartered accountants. That's a great value addition to all the members here. And all the speakers have done more than justice because you are all experts. Hats off to your the knowledge and the commitment. Especially Prabhakar sir has been sitting after presentation. Also, he has been sitting here to continue to this program. So I wholeheartedly thank the chief guest for the day in absentia once again, Rajeswari madam, and also Jayasimhan sir, who are not here. But that apart, the lucidity and the way you presented the slides, sir, Prabhakar sir, it was so good and so crispy that even this that nobody could have felt it difficult to understand the concepts or the intricacies of the system. So thank you very much, Prabhakar sir, and also the team of Vijay Kumar sir and Venkatakrishan sir. Excellent combination of both of you. One was batting and another was on the runner side, but still it was so good partnership in presentation also. Definitely we have added value, and most of the members who have attended today would have definitely they will start seriously thinking on finding out an opportunity or an avenue in this area, for which we all should be indebted to you. And on behalf of SIRC, we thank you all the three for your efforts and your passion to spend time here. I also thank our chairman for selecting this topic, which normally the first sight would not create interest, but once if somebody has attended today, definitely through word of mouth it will spread to other members also. That's the great message that you have given through this program. Thank you, chairman, and also the back office, and also Geeta madam, who has come here today for this program, our this regional colleague, and also back office of SIRC, and Selva, our technical support. Thank you all. Very importantly, thank the delegates in good number. But for your participation, definitely such programs cannot be continuously conducted. So thank you very much to all the delegates, and wish you all a happy stay. And I think the restrictions are slowly getting relaxed. This COVID relaxation should not lead to another COVID wave. We shall all take care. Thank you all, and good night.
Thank you, sir. Thank you. Thank you, sir.
Thank you.
Thank you.
Thank you. Thank you.